statement that you would like to make to the committee. So if you could make your brief introduction and the statement, please. Thank you.
Mr. Chairman, my name is Lex Greensill. Thank you for the opportunity to participate in this important hearing to answer your questions, and I hope to provide clarity and greater understanding of the issues before us. Please understand that I bear complete responsibility for the collapse of Greensill Capital. I am desperately saddened that more than 1,000 very hard-working people have lost their jobs at Greensill. Likewise, I take full responsibility for any hardship being felt by our clients and their suppliers, and indeed investors in our programs. It's deeply regrettable that we were let down by our leading insurer, whose actions assured Greensill's collapse, and indeed by some of our biggest customers. To all of those affected by this, I am truly sorry.
Okay.
Mr. Chairman.
Thank you very much for that. Could I take you back to a very specific moment in time, to the 12th of July 2019, when you had a meeting in your offices just off the Strand, I believe, with Lord Myners. I believe this was a meeting, or he described as being about an hour and a quarter, but whatever length it was a fairly lengthy meeting. And when he gave evidence to this committee, he left us strongly with the impression that he had had a meeting with you in which he had expressed disquiet about the business model that you were following. He told us that when he left the meeting, when he'd gone down in the lift afterwards and he was thinking about it, into his mind came the idea that what was going on here was, and I am paraphrasing him, tantamount to a Ponzi scheme, as he described it. Could you just tell the committee a little bit about that meeting? What kind of concerns Lord Myners raised with you about the structure of the business and the model of business as it was, and what answers you were able to provide him to try and reassure him that actually Greensill was a viable and sensible business?
Certainly, Mr. Chairman. I think I would say at the outset that I was very surprised to hear the evidence that Lord Myners provided to this committee 2 weeks ago. And it is not consistent with my recollection of the events. My recollection of the events, and I have checked my records before addressing you today, is that Lord Myners was the chairman of Edelman, who is a communications firm that represented my firm, and through them he requested an appointment with me, and you're correct that he met with me on the 12th of July 2019. That was in response to questions that he had raised in the House of Lords concerning the way in which certain open-ended investment vehicles operated and the liquidity that they provided and the mismatch between those and the underlying assets. We had that meeting. Obviously, it was a meeting we took incredibly seriously, given Lord Myners' position and the positions that he previously held. I felt that we had a constructive discussion where I was able to discuss and explain the differences between the assets that he had been talking about in his questions that he had raised in Parliament and those of working capital finance or supply chain finance assets, which have importantly different characteristics, largely because the duration or the period of time that the assets are outstanding is very short. They match receivables, which get paid very, very quickly, and so self-liquidate. I thought we had a constructive discussion, and we talked about the fact that as we grew, we were going to move into ever more regulated spaces. He noted, as I told him about our plans for the future, that we really didn't have any advisors or directors with any substantive regulatory experience, and I suggested to him that we could benefit from his experience, and he seemed very amenable to that. I said that he clearly would want to do more work to understand our business, and indeed that was followed with a subsequent meeting that he had together with my chairman on the 3rd of September. But I think an important detail...
Sorry, Lex, can I stop you there just on that point? So the meeting on the 3rd of September with the chairman, are you saying that Lord Myners attended that specifically with the purpose of discussing the potentially joining your board or joining as an advisor of Greensill? Was that the reason?
That and clearly continuing his diligence in understanding our business and our activities. But I would like to read to you, if I may, Mr. Chairman, a statement which was sent to me that was prepared by Lord Myners after our meeting on the 12th of July that he proposed to make. But in fact, we collectively decided not to publish that statement simply because the reality was the matter was practically closed. However, I think it's now relevant for me to read you that statement that Lord Myners provided to us in writing. My question, and I'll read, I quote, and this was provided on the 13th of July. My question in Parliament was linked to open-ended funds and illiquidity. I've asked many other questions of the same issue in my time in Parliament. In the light of press commentary, I took it upon myself to meet with Lex Greensill to discuss his business. I found him very open, and following the meeting, I am comfortable with the business and its operations. I heard and saw nothing that would warrant the use of the word fraudulent or anything similar. Okay. He then met with my chairman and I on the 3rd of September. He then subsequently attended, I believe it was a breakfast with just my chairman on the 18th of September and wrote a very complimentary note directly to me afterwards, which I can share with the committee if required. And then on the 7th of October, Lord Myners wrote to my chairman and I will read that short email to you if I may. Dear Lex and Morris, congratulations on securing further backing from Softbank, a powerful endorsement from a global investor of standing. Last week, I had a coronary angiogram at Hammersmith Hospital. The consultant surgeon has advised me to reduce my workload. In the circumstances, I think I must decline your interesting idea and not waste your time by commencing any detailed diligence. I wish you well. Regards, Paul.
Okay. Can I just go back to the statement that you read us from Lord Myners? Just to be absolutely clear, is that a statement that he produced and provided to you? In other words, it was authored by his own hand in one form or another?
It was sent to me by Edelman, and they said that it was sent to them by Lord Myners.
And can you tell us who this middle person is?
Yes, I would be happy to provide that in writing subsequent to this discussion.
Okay, fine. Going back to that meeting on the 12th of July, was there anybody else present in that meeting other than yourself and Lord Myners?
No, the meeting of the 12th of July was simply Lord Myners and I.
Okay. On the 2nd of November, Lord Myners, I noticed, submitted another written question in the House, this time about bounce back loans, and also probing the issue of GFG alliance, etc. So he certainly at that point, which of course is after the 7th of October when he broke off the discussions with you, I guess, was back to being concerned about it.
Is that
all right? Sorry, do carry on.
Is that 2019, Mr. Chairman?
I beg your pardon. You're quite right. It's not 2019, it's 2020. You're quite right.
I think you'll find, Mr. Chairman, that Lord Myners didn't actually submit any further questions concerning Greensill Capital until the 22nd of June 2020, so 11 months after he met with me.
When he met with your chairman, Lex, on the 3rd, and I think again on the 18th for the breakfast, was that, do you have minutes of those meetings? Did the chairman keep a record of what was discussed? Do you have any correspondence around the setting up of that meeting, particularly in respect of what the purpose of the meeting was for, which I think you're suggesting was to further discussions about Lord Myners potentially becoming involved with Greensill in some form?
I can certainly look and see what correspondence and minute material we have available and come back to you in writing on that, Mr. Chairman.
Okay. All right. Well, thank you for that evidence. Can I ask you sort of more general question then? What in your view went wrong? Why did Greensill fail at the end of the day? What were the reasons for that?
Yes. The ultimate failure of Greensill was for one reason, but as ever, there are always associated reasons. But the reason that Greensill ultimately failed is because a material portion of our funding, Mr. Chairman, is provided by investors who require insurance together with that asset that they purchase to protect them against the default of that of the underlying receivables. Our principal insurance provider decided not to renew their insurance, despite being in discussions around renewing their insurance up to the hours before ultimately Credit Suisse determined they no longer would fund our business, which was roughly a week before we went into administration. And it was that withdrawal of insurance capacity which resulted in our failure. Now, of course, Mr. Chairman, that the reason, I'm sure you will ask me, what was the reason for the withdrawal of that insurance capacity? And I think that really comes down to three things. First, COVID. It had an impact on the entire insurance industry and on specific customers of ours. And indeed, I recognise that this body is considering what changes may be necessary to regulation, and I have some views about which you may wish.
Just to ask on that, Lex, what precise date was the insurance cover terminated within the arrangement?
It's expired at the beginning of March 2021.
Right. Okay.
And so, the first is COVID had an impact both on the insurance industry itself and on many of our customers. Two, as you'll be aware, we did have some concentrations, and indeed those are a source of regret to me with respect to some of our larger customers, which no doubt you'll want to talk about. And three, the actions of the regulator of Greensill Bank in Germany created uncertainty with respect to our ability to continue to support and provide liquidity for a key customer that relied upon us.
Okay. If I sort of look at what's out there or was out there in the public domain, I'm thinking now 2019, basically, sort of if you were looking from the outside and you were looking for things that might cause concern about the business. On the 18th of March, the FT reported that Tim Hayward, who you'll be familiar with, was fired from GAM, one of the investors providing finance to the business, and who provided, I think, hundreds of millions of dollars in financing. And looking at the links Tim Hayward had with yourself and Sanjeev Gupta. We then have the various written questions from Lord Myners. We have one on the 10th of June. On the 7th of July 2019, Reuters reported that Greensill issued a full statement on Gupta bonds relating to guarantees provided by the Scottish government. On the 8th of July, analysts and bloggers Stephen Clapham and Mark Rubenstein wrote a blog on Greensill entitled Greensill Softbank and Cooking the Books. We then have on the 4th of May, sorry, we skip forward to 2020 now, FT reports that Greensill had suffered a raft of client defaults and that Greensill and credit insurers were having to cover losses in funds managed by Credit Suisse. Then we have a number of additional during June, and as we've already mentioned in November, on the 2nd and the 18th, questions from Lord Myners. What was your reaction to all of those things? And at what point did you, in that timeline, perhaps think there's something going on here in this business that I'm getting really quite concerned about?
Sure. So if one were to think about the year of 2020, I guess there were a number of things that at various points registered concern with me.
Can I go back to 2019 though? What were you feeling back at the time that Tim Hayward was fired from GAM and there were suggestions of a close relationship between him and Greensill and yourself, and you know the details. What were you thinking at that point? If I can take you back a bit earlier than 2020.
Well, I can't comment on matters as between Mr. Hayward and his employer. What I would note is that, in fact, every investor in any of his funds received more than par, and there was no loss on any assets associated with Greensill Capital by GAM. But I think any matter concerning Mr. Hayward himself, I can't specifically comment on. And I think you'll find that that event actually didn't take place in 2019, but took place before that. So
I think he was dismissed, was he not, in March 2019 or thereabouts? Actually, February, I think the 21st of February, GAM announces the firing of Tim Hayward for gross misconduct. But let's get back to the question. So the question, the nub of the question is, at what point along this timeline from early 2019 onwards do you start to think this business is not really as stable as I would like it to be, and I've got growing concerns about it? What was the moment in time when that came to your mind, would you say? Sure.
I think the first event that gave me concern, although not for our company, because we'd just recently received more than $1 billion worth of equity investment into our company, but I certainly had reservations and concerns about the state of the capital markets during March, April, and May 2020. You'll appreciate, and if you cast your mind back, you'll remember that the capital markets at that time were roiled by the uncertainty of COVID, and none of us knew what exactly was going to come next. As you're probably aware, although Greensill was funded by more than 50 banks and several dozen institutional investors, one didn't know what was going to happen in the future. As it was, we were able to continue to support all of the supply chains and meet every supplier's requirement throughout the disruption that took place then, but we didn't know, no one knew what was going to happen next. So, are you basically saying then, so during 2019, largely you were aware of various rumblings going on and press, adverse press comments, etc., some of which we've touched on, but you were basically feeling positive about the business. It was really once the pandemic struck, so around May, a little bit earlier than May, I guess, that you start to think, hold on a minute, this might not be as stable as I would like it to be. Would that be a fair summary? Actually, I would say that for our business didn't require that liquidity. The liquidity I'm speaking of and the conditions of the capital markets affects our customers, not Greensill, the company itself. But obviously it's important that we continue to support those customers. The first concern that I had about the position of Greensill, the company, as opposed to would COVID have an impact on the capital markets and therefore impact our clients, was in December 2020. And in mid-December 2020, our German regulator proposed a reduction plan with respect to the amount of exposure that we held for one of our customers that was going to be impossible for us to comply with. And obviously that position was disclosed to the investors. We were doing a capital raise for equity for our own company at the time to fund our continued growth. We disclosed that to the investors, and that meant that the capital raise, which was otherwise supported by two of the largest banks in the world, and was fully subscribed and looked set to close in late December or early January, we obviously had to pause that.
Okay.
As it happens, in January, Mr. Chairman, the BaFin agreed to a plan that we proposed, which dealt with that immediate issue. And then the next event was the failure of our insurer to renew, which was in March.
But if we go back to the pandemic, you seem to be saying, well, that there were problems in the capital markets, but that was for others to worry about, not so much Greensill at that point. Although there is a connection, isn't there, between the impact that it has on your clients and the stability of your own model of business. So, but are you saying back at, when the pandemic first started and all these problems kicked off, that you were really feeling pretty comfortable about Greensill's position? And that is, of course, coincident with when the lobbying really started from Mr. Cameron and yourself and others of the Treasury to get involved in the CCFF fund and so on. But are you saying at that point there was no need to sort of dash for cash or to raise money? At that point, it was all pretty okay as far as you were concerned?
As it turns out, it was completely okay, Mr. Chairman, but what we didn't know was what might happen in the future. Nobody knew what was going to happen next. And so we felt that it was prudent, given that Greensill was not regulated and therefore didn't have central bank access, that the CCFF facility was something that would be of utility to those of our clients who are eligible in their own right to be able to access the facility, just as the Bank of England had allowed back in the 2009-10 financial crisis.
So the fact that you were therefore seeking that funding because you were concerned about the future, as I guess almost every business in the country would have been at that point, does suggest that you had a need to go and raise that money to give you the comfort that you would ride out whatever was ahead, albeit that was uncertain in itself. Would that be a fair way of putting it?
I think a correct characterization is we didn't know what was going to happen next, and we felt that having, for want of a better expression, a liquidity insurance policy, which the CCFF provided to many businesses in the country who were making a material contribution to the country, was a prudent thing for us as a business to do, simply because nobody knew what was going to happen next.
Okay, so then the lobbying really starts, doesn't it? And we've obviously had the letters published today, and I think you had access to those on a confidential basis a little while ago, so you've had time to digest them. Pretty intensive lobbying, particularly from David Cameron. Can you just explain to the committee what kind of conversations you would have had with Mr. Cameron around that lobbying in terms of why the funding was necessary, and particularly on this point, your point about, well, it was necessary because we had an uncertain future and we needed to get some arrangements in place to cope with that and the potential commercial threat that posed. Would you have discussed that with him?
Certainly. So my discussions with Mr. Cameron centred on the facility that had been in place during the financial crisis, how that facility worked, the mooted CCFF facility, as you would have noted in the letter that the Governor of the Bank of England wrote to you, there had actually been comments from officers of the Bank of England concerning the potential need for supply chain finance support from the central bank. So we talked about that, and we talked about the fact that there genuinely was uncertainty about what was happening in the capital markets. And whilst I guess with the passing of time that we've perhaps faded into the mists of history. But if you remember at the time, it was an extraordinary time where liquidity was in very, very short supply. And so we were talking about what impact that could have on our supply chains. And that was also a concern to our customers, recognizing that we were financing millions of businesses and customers in over 150 countries around the world.
Would it be fair to say that the reason given during the lobbying, as far as we know it, for these approaches to the Treasury, the Bank of England, FCA, and so on, was that you were going to be helpful as a business to support SMEs and supply chains and getting liquidity and finance out there, rather than any mention of the fact, as I think we've now established between us, that part of the reason for trying to raise this money was also to shore up against a potential problem in the future due to the pandemic and perhaps other factors?
I think they're the same thing, Mr. Chairman. I think what our business was to deliver low-cost, real-time liquidity to small businesses, not only in Britain, but around the world. And that relied on proper functioning capital markets, and they were not functioning properly in March and April 2020.
But that's a great story, and it may be a perfectly legitimate, valid story for the Treasury to motivate them to do as you were trying to have them do. But it is not one of the big motivations here, which you and David Cameron both appreciated, because you would have discussed these things and you've discussed it with us now on this committee, that actually part of this push was to get cash into the business, because there would have been clear concern about the future of the business at that point, given what was happening in the capital markets as a consequence of the pandemic and other factors.
Mr. Chairman, I think it's important that I make something very clear, that Greensill itself, and indeed as the Chancellor put in his letter that he wrote to you and the Governor of the Bank of England, that Greensill at no time sought funding for itself.
Well, yes, but the model required, did it not, to sustain itself? It did need to have funding. The model needed to keep going, and having the funding coming would have kept the model going. And it's the fact, as you say, that the insurance were pulled that stopped the model working, and then the whole thing fell apart.
Our clients needed that continued liquidity, as has always been the case and will always be the case into the future, because these are real businesses in the real economy that are buying goods on a daily basis.
Okay, all right. So thank you, Lex, for that. I'm going to go now to Felicity, please.
Good afternoon. I want to follow up on a few points that you've raised with regard to your business model. Now, you've talked about the importance of the credit insurance, and that is clear. I understand that your insurers actually gave you notice on September the 1st to take effect on March the 1st. If I were in your shoes, knowing the importance of credit insurance to your business, I would have been doing absolutely everything from September onwards, either to have your existing credit insurer, Tokio Marine, sign up again, or to find a replacement, because this is the critical cog in the Credit Suisse Asset Management Fund. Did you do that?
Ms. Buchan, we absolutely were confident in the fact that our insurances would be renewed. We did business with 28 insurers through our brokers, the largest insurance brokers in the world, Marsh, who managed those relationships for us. And we worked intensively, not only with Tokio Marine, but with all of our insurers, as we did every day, to make sure that we had the capacity to support our business. It is a matter of fact that we had been working every week since that letter arrived to actually finalise a renewal with Tokio Marine, And indeed, one was drafted between us and in an agreed form before the end of the year. And so the view that we had was that we would either renew with Tokyo Marine or we would renew with others, recognising the number of other insurers that we worked with. And it's important also, if I can remind the committee, that for the credit insurance market, COVID was an extraordinarily frightening time when there was an expectation of very, very significant losses. Indeed, many governments, including the British government, announced support arrangements for credit insurers to try and help and encourage them to continue to provide capacity to the markets. And so actually, Tokyo Marine was not the only insurer to indicate that they would not renew, but in fact the others did renew, driven largely by concerns about regulation. And if I may, Ms. Buchan, it strikes me that one of the key regulatory shortcomings shown by the failure of my firm, and to be clear, I take responsibility for the failure, but one of the key learnings is that the credit insurance regulation structure works in a counter-cyclical manner. That is, when the market turns down and the probability of default of businesses increase, in order for the solvency requirements of the insurer to be met, they must provide more capital because the probability of default of the businesses they've insured goes up in a crisis. And that is what happened during COVID. So what happened was many insurers needed either more capital to provide the same amount of cover, or they needed to cut cover in order to fit within the limited amount of capital that they had. And that seems to me to be a crazy thing to have.
Okay, but let me take you to the verdict of the New South Wales Supreme Court. And they did not accept your lawsuit. They threw it out. And they said that they were given no evidence to show the talks took place to renew the insurance other than a letter dated February the 27th, 2021. And can I also ask you to react to that, but also as a supplementary, given how critical this credit insurance was, when did you tell Credit Suisse Asset Management that you did not think that you would be able to get credit insurance?
So let me answer the second question first, if I may, Ms. Buchan. So a number of our investors relied on insurance. They received information concerning the insurances that we held directly from our broker Marsh, who actually arranged the insurances, not us. And that information was provided to our investors on a real-time basis, i.e. every time there was a change, they received an update. So in many cases, that meant they were being updated on a daily basis. So they knew the termination date of the cover the same day that I knew about the termination date of the cover, because it was provided to me by the same mechanism that it is to my investors.
And the New South Wales Supreme Court, what's your reaction to them throwing out your lawsuit?
Look, we made a difficult ask of the Supreme Court, and we made the decision to do so on the weekend before our policy expired. We had fully expected that the policy would be renewed or extended. And when we found out on Friday night before it expired that they would not be renewing, we had to very quickly put together an injunction where we sought an injunction to have the policy temporarily extended. And I think the court felt that given the amount of money involved and the limited amount of time they had to consider the matter, that it was difficult for them to make that judgment in a very short period of time. But I can't speak for what was in the mind of the court, but what I can tell you with certainty, Ms. Buchan, is that we were working day and night for basically every day from when we received that letter on the 1st of September to put the renewal in place with senior management, the most senior
Let's move on, because I'm conscious I've got less than 5 minutes here, and there are a number of topics I want to address in terms of the business model. Now, you've talked about how you were lobbying Treasury in order to fund SMEs, but it seems to me that your business and the Gupta Group business had a huge amount of interdependence. Can you just tell the committee how much exposure you had to the Gupta Group and what percentage of your total exposure that was? And also, with the reverse, how much of the Gupta Group funding did you provide?
With the greatest respect, Ms. Buchan, I am not able to comment about specific clients. I've received a directive from the administrator of Greensill Capital specifically on that topic, as she's undertaking this, and those matters are confidential. And indeed, as you published in your materials today, there is a correspondence there from the FCA indicating that they are conducting their own inquiries. So I'm really not in a position to comment specifically on any particular client.
But the German regulator has clearly raised concerns about your dependence on that particular client.
And more correctly, their dependence on us.
Yes, absolutely. Mutual interdependence.
But I would say to you, Ms. Buchan, it is absolutely the case, as I said in my opening comments to your chair, that we did have a concentration on certain customers that was too high, yes. And I'm responsible for that. And
okay, let's move on in the interest of time, yes. Now, I want to take you up on the business model because it's short-term receivables repackaged with credit insurance until you come across this very bizarre concept of future receivables. Now, in my mind, there's no such thing as future receivables. You know, there's a prospect of doing business further out the line, but that's just the prospect. So if you're actually lending on this basis, this is simply unsecured lending. It's unsecured lending dressed up as receivables so that it can go into those funds.
Ms. Buchan, you are quite correct that if we had not taken security and funded future receivables, it would be unsecured lending. But in no case did we provide a facility that supported future receivable financing that was not secured on real assets, as you say, like a loan would be. And indeed, I put it to you that future receivables are widely used as a form of financing. Think about it, the largest pub groups in the UK finance themselves and their estate using future receivables. Most football stadiums.
Yes, but can I interrupt? There's a big difference between having a history of cash flows and projecting forward. I understand here that companies have said that they've been asked about receivables and they have done no business with you. I also see a quote from the German regulator, which says that they were unable to you were unable to provide evidence of the existence of receivables in your balance sheet that you had purchased from GFG Alliance Group.
Maybe I can address the German point first, and then your first point second. So with respect to our bank, we booked assets that were real assets. They were booked according to the advice and direction that we had from our auditors and from our legal advisors, and indeed were actually subject to a review by the deposit protection regulator in Germany, and we complied with that at all times. The BaFin indicated to us that they didn't agree with the classification of those assets, and so after a discussion with them, we adjusted the classification of those assets, but at no time was there a position where the assets didn't exist. It was a question of classification.
And so how did you classify them?
We classified them as receivables and we booked them as exposures against the various customers of our clients. And we'd insured and bought insurance against the event that those receivables didn't come into existence, plus took a comprehensive security package. Our regulator asked us to book that exposure as a single exposure against that customer, in effect.
So unsecured lending.
In
yes.
your words, as effectively a loan to
yes,
a...
precisely. Unsecured lending, yes.
Yes.
So can I make the point, in light of that there is not transparency here in your business model? The whole concept of future receivables is in effect a loan, unsecured lending, but it is being dressed up as supply chain finance.
Ms. Buchan, every asset that we ever sold was correctly described, and that information was prepared and made available to our investors, to our auditors, and to our regulators, and they had full and complete information at all times. So I don't accept your assertion.
I'm being told I'm out of time, but just one very quick question. When you were lobbying at Treasury to have supply chain finance approved, were other competitors of yours lobbying in the same way?
I can't speak for what other companies were doing, but I was aware that my competitors also were concerned about market conditions and were interested in the possibility of central bank support, but I can't speak for them. I'm sure you'll ask them to give you evidence.
And what was your reaction when Treasury said no? It seems as though they made the right decision, but what was your reaction?
Well, my reaction is seen from the actions that we took. I was very keen to see that the facility that the bank had put in place, the Bank of England had put in place during the financial crisis, was able to be made available again. But ultimately, as you rightly note, the Treasury and the Bank of England decided not to do so.
Thank you. Thank you, Chair.
Good afternoon.
Great. Thanks very much, Felicity. Rushanara, please.
Thank you very much. Mr. Greensill, I've got a number of questions, so we'll try and rattle through as quickly as possible. First, I have some questions about the lobbying process. Can you just talk me through what representations you and David Cameron made on your behalf, your company's behalf, to the Chancellor or Treasury officials about Greensill Capital's application to the Coronavirus Large Business Interruption Loan, the CILBILS loan, the design of that scheme, and the criteria for accreditation to the CILBILS scheme, including in the meeting that took place on the 24th of April 2020, please?
Ms. Ali, neither Mr. Cameron, to my knowledge, and certainly not I, we did not make any representations to the with respect to the setup of the CLBILS program, and the only conversation I ever had with the Treasury on that topic was a conversation which I had with the second permanent secretary at the Treasury, where I informed him after the scheme had been put in place and it had been announced by the British Business Bank that we were now able to extend loans under that facility, that it would be helpful, given the level of interest that we had seen, if we would be able to have the higher limit of 200 million instead of 50 million. And the British Business Bank had informed us that that was a decision that only the Treasury could make. Hence, I raised it with the second permanent secretary, and he subsequently wrote to me and said that he would need to see a request from the British Business Bank requesting him to do so. And as you would have seen in the correspondence from the Chancellor, no such request was ever forthcoming from the British Business Bank.
So it's really interesting because the 27 days of different days, Mr. Cameron lobbied government ministers and advisors, 56 emails and WhatsApps and counting, I hope, and other text messages. And for those of us who understand how lobbying works, the reality is you got what you wanted in the end, didn't you, Mr. Greensill? 400 million, is my understanding from press reports, of the seal bills loans to GFG-linked companies provided by your company. So the lobbying did pay off, even if it, albeit through a different vehicle, through the British Business Bank and, which is overseen by BIS. You did actually get a positive outcome, right?
Ms. Ali, as I say, I didn't have any discussion, and you'll have to ask Mr. Cameron whether he did, but I didn't have any discussion with any government official in the Treasury or the Bank of England concerning the CL bills facility or our eligibility for it until after the British Business Bank had determined that we were eligible, right, and announced it publicly.
Right. And BIS, did anyone have any links with the business department? Okay. So can you just confirm the press reports that Greensill loaned a total of 400 million in the seal bills GFG linked companies, and it was split out across 8 loans of 50 million? And could you just confirm that?
No, I'm as I mentioned earlier, I'm afraid I'm not permitted to make any customer specific.
This is about the past, and we're here to talk about the past and what your involvement. You've arrived in this committee. You've apologized for the 1,000 jobs lost in your own company and others related. I think you owe it to the British people to answer the question, Mr. Greensill.
I'm afraid, as I explained to your chair before I spoke, I've had very clear instruction from the administrator of Greensill and indeed from my legal advisors, and you will have noted the letter from the FCA. I'm simply not able to comment about specific customers, but I will help you in any way I can with your inquiries.
I think that people will infer from your inability or reluctance to come clean and be transparent on this committee, on this parliamentary committee, which you claim to have respect for, that actually, given the 50 million cap, it was, that actually what you were doing was you were deliberately restructuring in order to take advantage, and you were actually doing something that was beyond the scope of what should have happened. There was something improper went on here, which led to 100 million of loans being provided.
Exactly. Greensill Capital was selected by the British Business Bank as being eligible to operate the scheme. The credit that we extended to our customers complied with our ordinary credit rules and procedures, which were scrutinised by the British Business Bank. Each facility that we provided was reviewed by a top-tier London law firm, and where there was any question about the interpretation of the British Business Bank rules, we actually had that leading law firm directly discuss the matter with the British Business Bank in order to ensure that it did comply with the rules. So it is my opinion that every facility that we provided complied with the British Business Bank rules.
Interesting. And can you just talk me through how many other CLBILS loans Greensill made, or did you only loan to GFG-linked companies?
We provided facilities to other customers under the British Business Bank facilities. So not only to a single group, for example.
And how many of them would you be able to say?
I wouldn't be able to say.
Right. And is that because of the point you made earlier?
That's right. I'm not permitted to talk to you about customer confidential information. We're a financial institution. It's simply not something that I can discuss in an open forum, our clients' confidential information.
So just going back to the Lord Myners evidence session, and obviously you've addressed some points that the chair has raised. Lord Myners talked about the cost of, told this committee that the total cost to the taxpayer from the Greensill scandal would amount to £3 to £5 billion, including £1 billion in direct costs. And as you've heard the chair, he was quoted in our committee as saying, "I left the meeting traveling down in the lift thinking of myself, this has many elements of a Ponzi scheme." You have come into this committee today and you have discredited his evidence. You've tried to discredit his evidence. Who should we believe, Lord Myners or you? Who's lying? Who's not telling us the truth here in this committee? The public deserve to know the truth, Mr. Greensill.
Certainly, Ms. Ali, I have told the committee the truth today.
So are you saying Lord Myners lied to this committee?
Ms. Ali, I'm telling you what I have told you is the truth, and it is supported by written evidence.
Right. So Lord Myners is not telling the truth and you are. Is that what you're saying?
What I've said is I've given a correct account based on my knowledge and recollection and written evidence.
The point is, you've admitted to the failure and the cost yourself in jobs and the associated losses to other companies.
I have.
Lord Myners has talked about the amount, £1 billion direct costs, and it's in other referenced by others as well, right? And 3.5 billion indirect. What do you have to say to that? Is he lying about that in your opinion, or is he telling the truth? And is everybody else, I mean, it seems like you're gaslighting here. You know, you've blamed the insurance company, you're blaming Lord Myners, but the company that has cost the taxpayer money is your company, and it's you.
I don't recognise or know how Lord Myners came up with the numbers that he shared with this committee 2 weeks ago, and I haven't seen him publish a breakdown of how he arrived at that. I certainly have noted that others have quoted Lord Myners since then, but I haven't seen how he arrived at that number. But perhaps if we pause and let's see if we can work the number out together.
1 billion was
Right.
not just Lord Myners. That number has been in the public domain a very long time. So how would you calculate it? What has been the loss to the taxpayer?
There has been no loss to the taxpayer, Ms. Ali.
There has been no loss. So once again, Lord Myners is not telling the truth, is not giving the correct facts. Others who have given evidence are not giving the correct facts, but you are. We are expected to believe there's no loss, and you are telling the truth here.
The total amount of, we've just been talking about the CL Bills facilities. So the total quantum of CL Bills facilities that Greensill Capital extended was £400 million. The total amount of C Bills facilities that we extended was £18.5 million. C Bills and CL Bills facilities are guaranteed to the extent of 80% of the amount of the loan.
The knock-on effect on a company, on the seal company, and the knock-on effect in terms of jobs and consequences will amount to a greater deal of expense to the taxpayer.
Ms. Ali, you asked me how the calculation around the billion direct cost was calculated. What I'm trying to do is help you to get to the facts here. So the total amount of guarantees that from the British Business Bank, the guaranteed amount is £334,800,000.
Interesting. So we're talking about direct and indirect costs. Can I just, I'm going to move on to the question in relation to, and you may, once again, you may not answer this question, but I hope you will. Can you just talk us through when you started working with Mr. Gupta and his company, and when your company started doing that? Is that allowed? Are you allowed to answer that question?
I think some of that is actually in the public domain, so I'm prepared to comment on the parts that are in the public domain, Ms. Ali, as I'm genuinely trying to be helpful to you. I believe that I met Mr. Gupta back in 2015. I was actually introduced to him by an executive at Euler Hermes, who's one of the largest insurance companies in the world. We did a very small amount of business with Mr. Gupta initially, and that over time increased.
That over time, that increased?
Yes, that's correct.
Okay. I just have one more question in relation to insurance. You talked about the insurance company earlier, about the insurance facility not being, one of the reasons for the collapse of Greensill. Can you just explain how you come to that conclusion? Furthermore, a bit more about how you come to the conclusion that your company. Why should the public believe that that's the reason why your company collapsed, rather than the points that Felicity raised about the business model that your company used?
Well, Felicity has her own opinion, but you've asked me my opinion. What we've done is we have taken cash flows, which we collect from the accounting systems of our clients in real time, and made that information available to investors so that they are able to invest in the real economy in a way that hadn't ever been able to be done by anybody other than banks before. And through doing that, we've been able to provide finance to millions of businesses in over 150 countries. And those people did not do business with me, Ms. Ali, because of our brand or because of our marketing expense. They did business with us for one reason and one reason only, and that is they got a better deal from us than they could get from their banks. And so actually, what I would say is, to those millions of businesses and employees who made use of our technology, they voted with their feet. It is absolutely correct. We ultimately failed, Ms. Ali. So there clearly was a flaw in our business. But the fundamental truth is, taking real-time information out of corporate accounting systems and using that information to make credit decisions and make lower cost credit available completely electronically to small businesses and consumers around the world absolutely is the future. But the way that I did it definitely has flaws. And the insurance value.
Running out of time, but your company's conduct is hardly an advertisement for that kind of credit and small businesses to small businesses. And in fact, what we've seen is a concentration of risk. What we've seen is that unsecured loans, in effect, have been provided, and you haven't helped businesses. You've actually damaged the reputation of legitimate supply chain finances. And to conclude, in fact, Myners has a point, doesn't he? It is a Ponzi scheme. It is, frankly, it smacks of fraudulent behavior, and it franks of the sort of stuff we saw conducted by the likes of Madoff in the financial crisis. That's what it smacks of. It doesn't smack of a proper process where people can get supply chain finance that is reliable and credible.
Sally, when I started Greensill, no member of this committee, or indeed I think almost any institution, had heard of supply chain finance. Now, every major financial institution in the world offers it as a product, rather like a checking account to a corporate. That has meant that tens of millions of businesses have benefited from that.
Yeah, though, Mr. Greensill, isn't the problem here? It's not about innovation around a particular way to finance. Isn't the problem here that you and David Cameron, who pushed for this while you were an advisor in government, and then you and David Cameron stood to benefit from that process? The idea might have been a good one, but there is a clear conflict of interest here. You didn't do, your idea might have been valuable to the world of finance, but what you created ultimately, and the conduct of lobbying in the way that had happened, using a former prime minister, frankly, bringing that position into disrepute to benefit, to profit, is where the problem lies, and going so far that actually many would argue you and Mr. Cameron lost sight of what what was appropriate behavior and appropriate action in terms of providing supply chain finance?
Ms. Ali, the beneficiaries of Greensill and the business model that we developed, which is now being copied by thousands of financial institutions around the world, has not been a great boon to financial institutions. The reason it has grown as it has is because it's helped tens of millions of businesses.
That's not the point here. The point is, and many of our experts who gave evidence recently talked about where the positives are to supply chain finance. The question is whether what you created and what you were selling was actually proper supply chain finance or a Ponzi scheme. And I state to you that your scheme was something quite different from a proper, appropriate supply chain finance process that protects the public interest. And in fact, what your company did is lose taxpayer billions potentially, indirectly, and certainly a few hundred million up to $1 billion of public money. I'm going to stop there because I know others have other questions. Thank you.
Right. I think it's probably only fair, Lex, if you did have anything to say to that, to say it. You may not do, in which case you'll hesitate. That's fine. I will go on to Siobhan, please. Thank you.
Mr. Greensill, are you a fraudster?
No, Ms. McDonough, I am not.
Okay, because I'm a layperson and I've looked up the definition of fraud. It's an act or an instance of deception, an artifice by which the right or interest of another is injured, a dishonest trick. Again, as a layperson, it seems to me that this is precisely what your financial model of prospective receivables is, nothing more than a trick. Lending against transactions that have never happened, may never happen, and with companies that don't even know they're involved in the transaction, and then selling it on as a low risk bond. It's pretend, it's an imaginary thing. So how is that not fraud?
Ms. McDonough, the business that we undertook was properly described. All of our investors understood exactly what it was that they were purchasing. In any investment, there is risk, but what we did is we took the history and the current activity of our clients. That history and data enabled us to see what was going to happen in the future and allow businesses to be able to access credit. We didn't just do that for the private sector, we also did it for the public sector. And indeed, it was done by the public sector here in Britain before Greensill Capital was even funding government-related supply chains. So no, I don't accept your statement, but I do recognise that any financial asset comes with risk. And because we considered that our reputation would be harmed if our investors were to ever lose money, we spent tens of millions of pounds every year purchasing insurance to protect against an event where there was a loss that arose, and we took significant security packages to support that position. So we felt, and I continue to believe, that the business that we undertook was a business that helped the broader economy and frankly is in line with forms of financing that have been conducted here for periods of time long before Greensill Capital even started as a firm. I gave the example of hubs here in Britain.
How much were you paying for your insurance? You were paying 1% on unsecured loans, which were a risk of over 10%. How did you believe that the insurance you were paying actually met the risk?
So where the goods had been delivered and approved, we did extend unsecured credit. And in the history of our firm, there was a failure. One that was in the press was a British listed company, NMC Healthcare. It had supply chain programs provided to it by half a dozen banks, I believe, of which our institution was one. And our institution was the only one, to my knowledge, that was able to, through our technology, systems and processes, to correctly identify fraudulent or potentially fraudulent transactions and exclude them. Whereas my understanding is other financial institutions did fund those. That company ultimately went into bankruptcy.
In the papers, Mr. Greensill, in the papers signed by you to the administrators, you say that step one in your business was the customer, and I quote, the customer obligor is issued an invoice by the supplier in the normal course of business. However, this only happened about half the time, and most of your revenue related to times when no invoice was involved. Isn't this description deceptive?
Our business was all about financing receivables and future receivables.
But no other business does future receivables. They at least expect that there's an inventory. In half of your cases, there was no inventory and there was no invoice. There was no evidence of any activity or business whatsoever.
The condition of our facilities, Ms. McDonough, is that they must do business with the customer. They must have the history to support that and the data to support that. And we take a secured interest where it is a future receivable, so where the goods have not yet been delivered. And indeed, to protect our investors, we purchased insurance to ensure that in the event that there was an issue of any description, including fraud, the insurance would be effective. And if I can come back to my NMC Health example, our investors there, even though that company actually did apparently or allegedly commit fraud, and we excluded the fraudulent transactions, our investors were paid under our insurance policies. So they were protected.
Mr.
That's
Greensill,
why we spent the money on that.
For clarity, I'm not accusing anybody of fraud other than yourself. In 50% of cases, there was no inventory, there was no invoice, and the insurance that you paid cost substantially less than the risk you held. You have much more experience and knowledge than me. You knew that that insurance would never cost the risk that you was actually wrapped up in your business.
I disagree with your assessment, Ms. McDonough.
Yeah. In the Companies House submission, you described Greensill as a supply chain finance company, but this represents only 10% of your business, as I think Felicity has already said, with 90% representing unsecured loans to high-risk borrowers. Are you trying to deceive creditors about your company's true business model?
No, I'm not deceiving investors around the business model of our company. We never have. And we went to great lengths to make sure that not only did our investors have full information about what they invested in, but indeed that in fact, we also, in many cases, provided insurance to protect against the event that actually there was a default, and that insurance had been proven in many instances over the years to be effective and to protect the investors.
The government's coronavirus support programs were introduced at the same time as you were trying to reduce your exposure to GFG Alliance. Mr. Greensill, was it your intention to shift as much of that exposure onto the government books and ultimately the British taxpayer, using a former Prime Minister to aid your case?
Ms. McDonough, I am not able to comment on specific clients, as I mentioned earlier.
And earlier in your evidence, you suggested that the public sector didn't lose out from your dealings. But in the list of creditors that you submitted from your firm includes Islington Council, only a few miles from Westminster, which is currently owed £100,000 by your firm. Don't you think you should pay them back?
We owe, with respect to council tax on the offices that we have in central London, and that's where that arises. And I'm extremely sorry that that's occurred.
Okay, thank you, Chair.
Thanks very much, Siobhan. I'm going to go to Angela, please.
Thank you. And I want Mr. Greensill to talk about this concept of prospective receivables rather than future receivables, which seems to be even more detached from actual business that is going on and be almost entirely speculative. How much of your business actually that you wrote actually was prospective receivables?
Dame Angela, the percentage of our business that was prospective in receivables was 0. I've never heard of the concept. I read about it in the Financial Times. If you were to look at the documentation relating to any of our facilities, you would never see those words appear.
So you weren't, just to make absolutely certain that I've got you correctly here, Mr. Greensill, you're saying that you never financed a deal for any invoicing, supply chain invoicing that hadn't actually happened but might be in some future period expected to happen. In other words, a future receivable or a prospective receivable.
But we did provide facilities with respect to future receivables. I'm not familiar with your description of a prospective receivable, but as I was explaining to the previous member, we provided secured facilities, not unsecured facilities, that covered future receivables. The only exception, in fact, to that, Dame Angela, is in the case of Her Majesty's Government and the NHS Pharmacy Early Payment Scheme that we funded. Those were future receivables, and there we did not take security. That program has been running since 2013. We took over together with Talia funding that in 2018, and that program, which is funding future receivables, allowed pharmacists to reduce their cost of capital according to the PwC cost of service inquiry, which was undertaken in 2011. It enabled the reduction of the cost of capital that was paid to pharmacies. So at taxpayer expense, pharmacies were reimbursed for their cost of capital, which was previously 12.3%. That was the average, was 12.3%. In fact, for small pharmacies, it was over 17% that was being reimbursed.
Mr. Greensill,
all of that cost was removed.
I think that there are
and the cost became much lower.
I think there are going to be some questions about that subsequently, but I know that you said originally that you'd never heard of the concept of future prospective receivables.
I said prospective receivables is not a concept in any of our documents.
Let's get back, rather than worry about a phrase. Let me rephrase the original question then. How much of your business was actually future receivables?
Of our total flow, so last year we funded $143 billion US worth of receivables, and the future receivable component of that, I don't know the exact percentage off the top of my head. I will provide that to you as a written answer post this, but it would have been less than 20% of our activity of the receivables.
Okay. That would be very helpful, and perhaps in that letter you'd also let us know whether that percentage had gone up over time as your business approached its final denouement, which obviously nobody knew about. That would also be helpful, so I can get a sense of whether you're becoming more reliant.
Perhaps I could provide you the 2017, 2018, 2019, 2020 numbers so that you're able to see that, Dame Angela.
That would be very helpful. Now, the other issue about this particular future receivables concept that's worried me while I've been looking at this is that the FT has published clear evidence of invoices referring to firms which now say they never traded with Gupta or GFG Alliance or you, and yet you seem to have securitized some of those invoices. So that rather hints that there's some fraud somewhere, doesn't it?
Dame Angela, as you'd appreciate, I'm not able to comment on specific clients, and certainly ones where there's the possibility of an investigation into that. What I can tell you, of course, is that at no point would we or my firm have engaged in financing receivables which we knew to be fraudulent.
Of course not. But what due diligence did you do, especially in those groups that, if I could say, you were sort of had a symbiotic relationship with, such as GFG?
It's worth noting, Dame Angela, that GFG was not our biggest customer. We had bigger customers than GFG that we provided more funding to. And in all of our clients, the core of our business was accessing directly and generally in real time their accounting systems to extract from them both current and historical trading information to enable us to make informed and real-time credit decisions around our ability to support the supply chains in which they operate.
No, and I understand that it's possible to do that by going into systems if the trade has actually happened and the invoices exist because there's actually been a transfer. But if we're talking about prospective receivables, how did you check that there was no fraud there? Because it just seems so convenient that you can package up and securitize something that one of your clients says has happened with a future flow of payments attached, so that you can then sell that as an asset, when in fact it looks like the situation has arisen that these were all fictional. And so what you were actually selling into the Credit Suisse bonds and marketing to investors were things that were just unsecured lending and wishful thinking.
Dame Angela, as I said before, with the exception of our UK government future receivable program, the other future receivable programs were secured, not unsecured, and benefited from insurance. But let's use the UK government future receivable program to answer your question. So there,
I don't want to talk about the UK government future receivable program. I want to talk about these securitized investments that you sold into Credit Suisse. How did you check that these things had actually happened and they weren't just the figment of somebody's imagination in say, the Gupta Industries?
So we securitized the UK government future receivable assets just as we did the others. And what we did is we took real-time and historical information, which we used in order to make projections as to what would happen in the future. And if we were to use the pharmacy example here in the UK, for many years, that operated where we built an algorithm together with the Department of Health that predicted what the value would be of each prescription that was filled here in the UK, and ultimately even predicted how many prescriptions would be filled in each pharmacy here in the UK. And that program, because we were able to provide that financing ultimately at less than 1% per annum, compared with the weighted average cost before that PwC determined and the government was reimbursing of 11.3% per annum, that saved the taxpayer £100 million, or more than £100 million every year. Well, that is the saving that comes from using technology, capturing information, historical and expected future activity from accounting systems of clients. It saved the taxpayer over £100 million a year.
Mr. Greensill, I'm talking about what's gone wrong and why your company collapsed and why there are now huge amounts of losses, not least to those that invested in the Credit Suisse bonds. I'm just going to ask you again, what kind of due diligence was done when you securitized these prospective receivables from the GFG group? Because it looks increasingly, and you don't have to comment on this, but it looks increasingly like the case that you were securitizing invoices that didn't really exist on flows of money that weren't due. Now that, has meant that the Credit Suisse investors have lost large amounts of money, that lots and lots of people have lost large amounts of money because they've invested in bonds and assets, so-called assets, which you created and securitized, which were actually unsecured and high risk, not low risk, as they were marketed by you.
So we did, the diligence that we conducted was all outlined in the security documentation that investors purchased. They did so with full knowledge. We did it based on the data that we collected from our clients, but they made a decision, just as we did when we purchased those assets as a principal for ourselves, that we trusted those clients and that the data that we were collecting and the verification that supported that was sufficient. It may well be the case that we learn lessons that say that more should have been done by us, but that's something for the future. But I would emphasize to you that so far, no one has made a loss. That is the reason we purchased insurance, to protect investors against that potential catastrophic event.
But are you saying that the insurance is the security rather than the physical assets that you're meant to be selling?
Not at all. Wherever, as I said before, Dame Angela, and I'm afraid you've contradicted me on a number of occasions, but I'll correct you one more time. Where we did future receivable programs, other than for the British government, to my knowledge, all of them were secured against real assets to support those facilities.
Can you tell me how you can finance at 1% and pay insurance premium and all of the other costs that go with securitization?
Sorry, you've said that we financed at 1%. I presume you're referring to the UK government supply chain program that I was referring to?
Yeah.
The margins, we actually charged a lot less than 1% in the case of the UK program. And it's the insurance that we pay is based on the probability of default of our customers. The probability that the National Health Service is going to default is quite remote, so the cost of that insurance is quite low, and our investors are prepared to buy that asset at a level that reflects that risk. But it is true, we made a very modest revenue on providing the solutions that we did to the British government. Indeed, in aggregate, we made a loss providing these solutions to the British government. But the beneficiary of that was the taxpayer, in the savings of over £100 million a year, and of the many businesses that supplied the National Health Service, who were able to access credit at less than 1% per annum.
Now, the person that wrote your insurance for Tokyo Marine was dismissed for writing too much insurance and taking too much risk. Isn't that what caused your business to collapse in the end?
I can't comment on an employee relationship within an insurance company, but what I can say, and I did say at the outset, is that we had an over-reliance on insurance generally, and we purchased too much of our insurance from one particular insurer. Even though we did buy cover from 28 different insurers, we did too much of our business with one insurer, Dame Angela, and that's definitely a learning, and I take responsibility for that.
And what kind of security did you have on some of these securitized assets that you sold into Credit Suisse? Because I've read in various places that although these are meant to be short-term assets, that you backed them up with very, very long-term illiquid security, buildings and things
Right.
like that.
Correct. So we were financing the working capital of the business, but in the event that there was a default, we had security, and the strongest form of security is absolutely to take security over bricks and mortar, and inventory, receivables, and other assets of a business.
Just one final question, and that is, Gupta was actually, was he on your board, or he had some shares in the company at some stage? What was going on there?
Mr. Gupta was never on the board of my company.
You have shares?
Yes, there was a very short period of time where we at that time were doing a small amount of business with him. He bought a small stake in our firm, and then subsequently we decided to do significantly more business with him. And my board and I judged that it wasn't appropriate to be having him as a shareholder and provide more than a de minimis amount of facilities to him. And so he sold those shares completely, and those transactions were effected within a couple of months of him becoming a shareholder and then selling out. And he did not make a profit on that sale. He sold the shares for the same price that he purchased them.
And did you do the same thing with Softbank, given that Softbank also financed Greensill and then seemed to have borrowed extensively from the Credit Suisse fund?
So none of the two large institutional shareholders that we have borrowed money from Greensill Capital. I think what you might be referring to, Dame Angela, is that we provided facilities to companies in which Softbank Vision Fund was a minority equity investor in other companies, and we provided certain facilities to those other companies. That's correct.
Thank you.
Thanks, Angela. To Alison, please.
Thank you, Chair. Mr. Greensill, in the 2019 annual report for Greensill Capital, it lists concentration on certain customers, key employees and suppliers as one of your key risks. Can you tell us, did you feel you were carrying a concentration risk at any point?
I'm sorry, ma'am. Would you mind just saying that question again, please?
Sure. In Greensill Capital's 2019 annual report, it lists concentration on certain customers, key employees and suppliers as one of the key risks in the annual report.
Yes.
Given all that has occurred since then, did you feel at that point you were carrying a concentration risk, or at any point before or after?
Our annual report is accurate, and it is the case that in a small company, when you start, your first company, the first customer you do business with, by definition, is a big concentration risk. The first partner that you have who provides you with services is a big concentration risk. When Greensill Capital failed, we were a little over 9 years old. And so as we grew, it is absolutely the case that we had concentrations that were unacceptably high, and we worked hard to bring those down. But as I said in my opening remarks, it is the case that concentrations we had, both on insurance and clients, were too high, and were the principal contributing factor to the failure of my company, which is to my very significant regret.
And in identifying those risks and appreciating those risks, which you clearly did, what action did you take?
We built a very material risk function, compliance function, and also continued to build out our legal function. We changed the way our risk approval processes worked. So we created a separate credit committee. I was removed from the credit and risk approval processes of the firm, such that any members of our board were unable to participate in the risk approval processes. Additionally, as we grew, we aimed to further diversify our business, which we did do, but clearly not enough when COVID comes along and significantly disrupts the insurance world and indeed that of a number of our clients.
And at what point did those alarm bells start ringing for you that perhaps your survival had become too linked to any one of your customers and that there was too much risk in one place?
Certainly, it was apparent that that was the case in December last year when the BaFin wrote to us and proposed a reduction plan that was unachievable for us to do, and potentially, had they implemented it, and to be clear, they did not order us to make that reduction plan, they proposed it to us, but had they implemented it, that would have likely been catastrophic. As it turns out, they ultimately agreed a different plan with us, which we were able to work to, and we expected to be able to meet. So it was clear to me in December last year that that concentration was potentially a risk to the entire firm, but we had been working diligently to reduce our exposure prior to that date.
So it can't have come as a huge surprise to you?
As in December, is that what you mean?
Yes.
Yes.
If they're coming to you with this decision, that can't have come out of the blue entirely then, surely.
Certainly it did come out of the blue in the sense that we actually had agreed to and basically been following a concentration reduction plan up to that point. But the BaFin then proposed, or rather suggested that they were going to propose a much more onerous reduction plan, which we would not have been able to comply with and would have potentially put our firm at risk. But I want to emphasise they ultimately did not implement that plan. But out of transparency and completeness to the committee, I wanted to be open with you about the fact that that was the point at which I became concerned, and it was that point that then triggered us bringing in restructuring advisors to advise us at the end of December, on the 31st of December last year. We appointed advisors to assist us around managing that risk and making sure that we were going to be able to carry on in serving all of our customers.
Okay. I mean, it seems a bit odd to me, given how you described to Ms. McDonough the kind of crystal ball-like qualities you had within your business for predicting what was going to happen in different businesses, that you didn't see this gaping big hole in your own.
With the benefit of hindsight, it seems that you are right.
Okay. You talked about in one of the answers about your business model being copied by other organisations around the world. Given what's unfolded here, should that worry us?
I think, as I mentioned when I was addressing your chair, I think that one of the real lessons from the failure of my firm and the impact that it's had on, the 1,200 employees that we had, is that a heavy reliance on trade credit insurance is dangerous. And I would urge you and the committee to consider the manner in which that is regulated, because it is fundamentally counter-cyclical in its behaviour. And there is a long list of companies, not financial institutions like mine, but there is a long list of companies here in the UK that have been put out of business by credit insurers making changes which are driven by the turn of the economy, which of course is what happened when COVID broke out earlier this year, last year, and obviously had an unprecedented impact on our economy.
We talked a bit about the kind of exposure and having one kind of big company, one customer rather, which is quite big compared to the others that you had. What's the kind of balance that there was on that? And was the service that you're providing to that one large customer different to the way you were treating your other clients?
Sure. I want to emphasise that the customer that you all think is my largest customer was not.
Who was it?
I'm not allowed to say, but the British company that you keep talking about was not our largest customer in terms of the assets that we funded. So the error that we made and the importance in the business model was to have a diversity of capital available to support every one of our customers. And we had too concentrated a mechanism of funding for some of those larger customers. So in fact, our largest customer had a very diverse, committed funding from banks to support it. It was very, very stable. That is what we should have done more generally across our business. But there were a handful of customers where we were much more reliant on credit insurance and fewer investors, and that created a concentration risk, which ultimately undid the dream that an awful lot of people had and the good that we had done around the world.
If you were to put a percentage perhaps on the amount of your business that went through these large companies compared to your smaller clients, what would that be?
I guess I'm going to have to rephrase your question to accurately answer it. So if you think about our clients, they have thousands of customers and suppliers. So essentially, the party that we contract with tends to be the pinch point in between the purchases of goods and services and the sale of those on to others. And so in terms of those pinch point customers, we had between 200 and 300 of those customers in total. In terms of the kind of suppliers and the customers to and the consumers that supported those businesses on both sides, that amounted to more than 10 million.
Okay. And I wanted to ask a wee bit more about the issue you mentioned about insurers. And you mentioned, I think, one large insurer and I think 28 smaller ones. Is that the figure that you'd said?
It was 28 in total. Yeah. Okay.
And one of those disproportionately larger. And again, yes, could you give us a bit more of a description of what that looks like?
Yes.
How that breaks down?
I'm very reluctant to mislead you and the committee. So could I ask to provide in writing to you afterwards what the actual breakdown was, so that I don't kind of accidentally mislead you? But it was a material double-digit percentage with respect to Tokyo Marine.
Okay, because I think it would be useful for us to understand exactly what these risks look like to the company, exactly what the weighting is on where these things lie, so we can get a better idea of just how much risk there was in particular areas, because obviously this has gone badly wrong. This is a complete mess. The house of cards has fallen to the ground, and taking a lot of other things with it. So I think understanding the balance of where those risks were would be quite useful for us as well. And lastly, I was curious just on another point that you'd made about the assets you were securing against, and if you could give any examples of what perhaps those physical assets were.
Yes, so those, as I mentioned when answering Dame Angela's questions, those assets ranged from real estate to vehicles, to inventory, receivables, intellectual property, kind of credits and licenses of various natures, cash, and indeed personal guarantees in some cases of principles of the business, and often case security over the actual shares themselves in the companies that we provided these facilities to.
Okay, thank you. I think that's all the questions I had, Chair.
Thank you.
Thank you, Alison. And Steve, please.
Thank you, Chair. I refer to my registered shareholding in GlintPay, and I do so because I'm going to ask you about Greensill as a fintech business. Now, Mr. Greensill, I can't help noticing that in the midst of what must be a personal disaster for you, for former Prime Minister, for the employees you had and everybody else involved, in the midst of this disaster, if I may say so, your face seemed to light up a little as you started to explain that the kind of business you were conducting was the future and that others are following your suit. And I wanted to just give you the opportunity to tell us a little bit about that. What was it that was the new thing that you were doing, and how did that make you a fintech business?
Certainly. So the business that we undertook recognised that the extension of credit to small businesses in particular, but also to consumers in the economy, is largely predicated on information that is, and when I started the firm, or indeed actually when I started working in supply chain finance in the mid decade of the start of the 2000s, that information was trapped inside the accounting ledgers of businesses and governments. Had that information been made available on a real-time basis to banks or to financial investors, that would enable credit to be extended both electronically and much more cheaply because the risk was less. It's just that banks simply didn't know what was tied up inside a company's records. For example, the fact that they knew they were going to purchase some goods in the future, or that they'd already received those goods and they were going to pay for them at some point, or that an employee had already worked a certain number of hours and therefore was already owed a certain amount of money. By taking that information out of corporates and governments and making that available to the financial sector, we were able to reduce the frictional costs of delivering capital to other people. And to do that, I did note in your committee a couple of weeks ago, I think we were sort of somewhat described as Luddites. I suspect that the more than 600 people who worked in my business in technology and support functions, a great many of them here in the northwest of England, would have been pretty shell-shocked to have heard that. But frankly, it would be impossible to do that at the scale that we were doing it. We were extending credit on an average day in the order of $500 million. It simply would not be possible to do that kind of with pens and paper. It had to be based on technology, Mr. Barker.
It's Baker, but don't worry about it. But I mean,
I apologise, sir.
No, it's all right. Don't worry about it. It's not the end of the world in all the circumstances. So the point is, you're using technology to get inside people's accounting ledgers to understand what's going on and to reduce the cost of providing credit. And I think you've articulated that really well. You mentioned employees and their wages. I think that's this app called Earned. Is that right?
Yes, sir.
And is that still in business? I'm afraid I haven't quite caught up.
That Earned was sold. And was purchased by WageStream, which is a British company.
Yeah.
But to be clear, that service was offered before my business entered this space. However, the difference was that service had a unit charge to it, typically a charge of a pound or two for the employee to be able to access their pay early. Because we were already integrated to the accounting systems of many private sector and indeed some public sector entities, we were able to easily use that information to effectively allow employees to get access to the same thing. And so we were happy to provide that service at no charge to employees, largely because it was using the existing infrastructure that we had built, recognizing we made millions of payments, and we already had that infrastructure.
So tell us a bit about that infrastructure. To what extent was it proprietary? To what extent did it use AI, machine learning, all those good things?
Certainly. So like all businesses, we invested heavily in continuing to grow our technology. So it would be fair to say that when we started the business in 2011, the technology of our business was largely Excel spreadsheets. But as our business grew, we very quickly had to adopt more and better technology. We were on the 4th generation of our technology at the time that our company went into administration, which was substantially reliant on artificial intelligence and machine learning to deliver the solutions that we did. But the infrastructure of what we undertook was somewhat unique in the marketplace, and we were certainly, for example, amongst the biggest or the largest non-bank issuer of bonds in the market. So taking millions of payments every day, crunching them together and delivering them on to investors.
So the reason I ask about this is that David Cameron, I think, explained that the reason he wanted to get involved was because you're exciting fintech. Now, as a software engineer, I can fully understand that you start a business with Excel and make your way towards machine learning. But I understand that at some point in this, you were using something called Taulia Systems. Tell us where Taulia, or however you pronounce it, where did that fit in your technology journey?
Certainly, it's pronounced Taulia, so I guess we're even on this.
We are even.
Now.
There we go. At least on this
square. We worked with a bunch of different partners actually, and Talia were specific specialists in working within an SAP environment, which is one of the largest ERP providers, which you'll understand. We also worked directly with Oracle. We worked directly with a number of other software firms. I think we had more than 10 partnerships with different companies that we partnered with, in order to have various capabilities that we needed to use. Of course, we then unify those with our own proprietary technology and deliver them on. Like most technology firms, we use some stuff under license and some of the stuff that we develop on a proprietary basis.
So in a nutshell, what were you using machine learning to do?
Certainly. Well, since we're no doubt going to talk about the National Health Service, the learning there is to predict at an individual pharmacy level what drugs are going to be prescribed in each individual pharmacy in England in the next 2 months, and allowing those pharmacies to be able to access cash against that prediction.
So this is why forgive me, because I could ask you about the technology all day and no doubt your engineers as well, but this is really the point of what I'm getting at, because on the one hand, you're still enthusiastic clearly about articulating your vision and what you were doing. But the central point here is the honesty of the claims being made by the firm and the honesty of the firm's business. There's no escaping that. And I think this goes back to the heart of the questions which were being asked earlier, this rather semantic discussion about prospective versus future receivables. So when you talk about those prescriptions being made, just to play it back, make sure I've understood correctly, you're saying that machine learning was used to predict what prescriptions would be made in the future and to use that information in order to provide credit.
It's the two data points that we were having to predict was the number of prescriptions that would be fulfilled in each individual pharmacy.
Yes. And
the reimbursement value of each one of those prescriptions. Those are the two data points effectively that determined how much a pharmacy would receive in reimbursement from the Department of Health.
So I can see there's the complexity here, because what you would do, I can see why people have used the word prospective, because those prescriptions had not actually been made, and yet you were providing credit on the basis that they would be, yes?
Correct.
Okay.
Based on the historical performance, the historical activity that had taken place in each one of those pharmacies in the country.
Okay, so this, I think, really is the heart of the matter. So when some people look at that kind of business model and accuse you or it of being a fraudulent business model, what would you say to them that makes it clear that it wasn't a fraud? Because I think that's the heart of what you're being held to account for here.
Certainly. We were using data inside corporate systems to allow the customers or suppliers that they have to be able to, for us to be able to unlock capital using that information. And using the example here in the UK in the pharmacy scheme, that meant that we were extending on average at any point in time just under £300 million on a consistent basis to pharmacies that wouldn't have been available to them otherwise. And almost all of that went to small pharmacies whose cost of capital was being reimbursed to them by the government prior to the scheme being put in place at a double-digit cost. So that saving accrued to the taxpayers using that technology.
Now, I have to tell you, I'm quite uncomfortable with this degree of securitization, even securitization of people's wages. Even as a free marketeer, I don't think anybody on the committee would say I'm quite possibly the most free market member of the committee. But I'm still, even so, rather concerned by the degree of securitization you're engaging in order to drive down the cost of credit. What is it about it that caused that glimmer of excitement in your face earlier about this kind of model? Why is it that we should? Why would you tell us that we should be wanting to support this kind of business in the future?
I wasn't asked to come and give evidence today to tell you why you should support this business in the future.
I'm asking you now because you told us earlier that this is with some pride, if I may say so, that this was the direction of travel in which the world was headed, and for the record, you're nodding. So that, in a sense, I'm really asked because I'm concerned now that this is a bigger problem for the future. If other firms, end up with similar business models, failing to spot their absolute weakest link on the point, in your case, of the insurance. My goodness, what a mess we could get into if this is where the world is going. So I'm really asking you in a sense, to tell all the journalists watching, all the mums and dads, all the policymakers and regulators, why should they be concerned to support this kind of business?
I think the value has been to reduce the cost of capital in the economy very significantly over the last decade. And with technology, we will get even better at being able to predict what's going to happen in the future. The key learning has to be, where does the risk for that failure sit? And in the case of my firm, Mr. Baker, because I relied on other investors, so our own proprietary balance sheet was insufficient to do this all by ourselves, that meant that if an insurance company withdrew, some of my third-party liquidity was no longer available. So I think the key question comes down to the durability of the capital that's supporting the businesses. And the durability of that capital can either come from that capital being within the control of the party that's providing the solution, or the durability could perhaps come from having greater certainty and longevity around the insurance that's being provided to those businesses, such as my own.
Would you agree with me that there's a major risk here that in using AI and machine learning to rapidly expand credit on a huge scale, that the risks of such a business model, indeed the risks inherent in any kind of use like this of that kind of technology, could very, very quickly expand beyond our capacity to regulate or contain those risks at all?
And I think that's why you're asking questions of me, so that you can make sure that you can understand those risks.
Well, I certainly have learned something today. Thank you very much.
Mr. Baker.
Thanks, Steve. And to Harriet, please.
Thank you, Chair. And I want to hark back to the time when your business was valued at $3.5 billion with the capital injection that you received from Softbank. And I just want to ask you what you thought about that valuation at the time.
My view of the valuation at the time was that it was consistent with the valuation of the business when our previous institutional investor had invested about a year before.
How many times earnings was it?
20 times. 20 times future earnings. So
And
it was 20 times 1 year forward.
You've mentioned quite a few times during your evidence that you obviously have a great pride in the service you were providing to pharmacies in the UK. Can you quantify for the committee how much value you think came from the fact that you were doing work that had the sort of imprimatur of the UK government on it, including, of course, an advisory relationship with the former Prime Minister?
When you ask the question, Ms. Baldwin, about the value, do you mean the kind of financial value, or do you mean more broadly than that?
I want to try and get a sense of whether you think that that $3.5 billion valuation had in it some kind of premium for the fact that you were obviously well embedded with the UK government and you had a former Prime Minister as one of your advisors.
Sure. So the multiple that SoftBank Vision Fund invested at was roughly identical to, or pretty much identical to the valuation that the previous investment about a year before by General Atlantic had been. And General Atlantic's investment took place before we had started funding any UK government programs. So I definitely think it was helpful, but I don't think that it was definitive of the valuation, given that the multiple remained the same. And relative to current market multiples, 20 times forward would actually be relatively low for a company that is in the financial technology space.
Okay, thank you. Turning to this sort of what looks to someone like myself as quite a sort of circular relationship in terms of some of the financing. You had Softbank investing as a capital investor. Were there cases of funds or firms rather that were both funding themselves through your supply chain finance product and then also investing either capital or investing in the funds themselves?
No.
So this report in 2019 from Bloomberg that said that Vodafone was putting invoices into a Greensill sponsored supply chain finance fund and also participating as an investor, and then Vodafone's treasurer coming to work as your CFO, that's not an example of what I described.
Actually, I'm mistaken. I had forgotten that one instance. So that is the case. But of course, it's not an investor in our equity. And I thought that was the question that you were asking me, Ms. Baldwin, was whether people were invested in the equity of Greensill Capital and we were then financing the same company. And the answer to that remains no. In the case that you've just cited me from Vodafone, they were investing in a supply chain finance fund, and we were also funding their supply chains. However, to be clear, at no time was Vodafone an equity investor in Greensill Capital.
Yeah, I asked about equity investor or supply chain finance funds. I'm sorry if that's not clear, but you're saying there was one example. There was only one example, and that was Vodafone.
I would say there are no examples where they were equity holders.
Yeah, but a supply chain, someone who is getting supply chain finance from your funds and also investing in the funds.
You'll appreciate that those funds, none of the funds were Greensill funds, and so they're not my clients, and so I don't know who were invested, and you would need to ask the managers of those funds if they were prepared to breach client confidence to share that. Obviously, I can confirm to you the position with respect to Vodafone because it has been in the public domain.
Okay, so you can't rule out that that was happening more extensively than just in the Vodafone example then?
To the extent that it did happen, it would be a tiny, less than 0.01% of the activity of our business. So it was not a core part of our business model, Ms. Baldwin.
And would it have been a potential conflict of interest that would have been noted in your policies and something that you actively managed or that the board was aware of?
It's difficult to see how that would be a conflict of interest, Ms. Baldwin. So no, actually, we didn't, because if you think about it, if someone invests in a fund, those funds will hold multiple assets. They are managed by a third-party fiduciary manager, not by Greensill. That fiduciary makes investment decisions based on the rules of the fund, and if a corporation or a financial institution wishes to invest in that fund, those funds are only funds that are open to professional investors, and so those professional investors would make their own determination. So no, that was not something that we had a policy on. We did, however, have a policy with respect to providing facilities to entities that were related to our shareholders. So i.e., you couldn't be a shareholder and we lend to you without there being a very specific process that had to go through the highest level in our board to be approved.
So turning again to the Softbank example, and they were clearly an equity investor. They also, it is reported, invested in Credit Suisse funds, but you're saying that was a separate organization to yours and you couldn't really get involved in that particular conflict of interest, but you were also receiving a loan directly from Softbank, as I understand it. Did you ever feel uncomfortable with all these different dependencies and different relationships that you had with Softbank?
Certainly. I should be clear with you that the loan, such as it is, that is on Greensill's balance sheet with Softbank, is a convertible loan that is essentially equity, and it automatically converts into equity upon receiving regulatory approval Greensill Capital is actually an Australian company, and in Australia, foreign investors need approval to be able to invest. And because we owned 100% of a bank in Germany, it also required German regulatory approval. So that loan automatically converted into equity when those approvals were granted, and that loan carried an interest rate of 0, and it had a 10-year term. So in effect, it was equity. So I just want to be clear there with you that it was for all intents and purposes, it was equity.
But you had mentioned earlier that Mr. Gupta sold his shares when he wanted to benefit from the supply chain finance. But you're saying that this was a different case with Softbank, because although they were an equity investor with you directly, you were not at the time aware that they were also investing in some of the Credit Suisse funds?
I was aware that they were investing in those funds, yes. But there was a meaningful gap in space and time between that. So their investments into, I think their last investment into Greensill, equity investment into Greensill Capital was, I think in October 2019, I believe. I think, as reported in the press, their investment into the Credit Suisse funds was, I think, in the second quarter of 2020.
But help me out in terms of what distinction you make between that example and the example you gave earlier with Mr. Gupta's equity investment. Where the board decided that he should sell his shares, yeah.
Yeah, but I think if you think about the metrics there, here Softbank is a shareholder in Greensill, and Softbank was also an investor in a Credit Suisse fund. They're two separate kind of investments. Greensill wasn't lending money to Softbank, so the difference with the Gupta example was Mr. Gupta was a client of our firm, and to be fair, there was that conflict for a very short period of time, which is why we ultimately, as our firm got bigger and we decided that wasn't prudent for us, we decided we shouldn't have, without very special approvals, shareholders that we lent money to.
Okay, and can you talk a little bit more about the conflict of interest that came about from Softbank being an equity investor in your firm, and for example, you getting involved in providing financing to some of the companies that were in their vision fund? Were you lent upon to do that?
No, we were not lent upon to do that, but absolutely there were additional controls required there. So, for example, I stepped down from, so when our company was young, I sat on all of the committees in the company. Obviously, as we got bigger, that was no longer appropriate. And in the case of both the credit committee and the risk committee of the firm, I stepped down from those committees, and nor was any other board member a member of the credit committee. The risk committee, of course, did have members of the board sit on it, but I was not a member. Those controls were there to make sure that credit that was extended was done so purely on a standalone basis, taking account of the veracity of the company in question, and not based on kind of who one of their minority shareholders might have been.
So it was just complete coincidence that so many of the Vision Fund investments were also customers of yours?
We were introduced to those companies by Softbank, so there was no sort of coincidence, but it is. But we obviously did business with, as I mentioned earlier, hundreds of companies, and Softbank Vision Fund companies amount to a very small handful of those, fewer than 10.
But I mean, the FT has reported, for example, that you only started financing the car company Fair after they'd already become, it's become quite evident that they had difficulties. The chief executive had announced plans to cut 40% of the workforce and had resigned, for example. Did you feel lent upon by Softbank in that example?
No, I did not feel lent upon by Softbank, and that particular facility, which has been repaid in full, did not result in any loss to our company and was repaid 100%. So I guess
you don't feel that throughout this this period of incredible expansion in terms of the business that you were doing, that you came across any business that represented in anything written by your firm that was represented a conflict of interest in any way?
In any business, there's going to be conflicts. What I would say to you is that we felt that we managed those conflicts by keeping the decision-making separate. So I'm not saying to you there's no conflict whatsoever. There obviously is some conflict between a minority shareholder in a company that we lend to and a shareholder in our company. The management of that, to try and mitigate the risk of that conflict, is about separation. But also, when we sold those investments to our customers, to our investors that bought those assets, they were aware of that information, and those assets came protected with insurance to protect them against an event of default, but they had the full information to make that determination. So I think there's several layers of consideration there, but I'm not saying to you there is no conflict. What I'm saying is we aim to manage it and we gave disclosure.
And if you were a regulator, because to me this sounds all quite worrying, that there was a bit of an arm's length, but it doesn't really pass the smell test to me now. If you were a regulator, what change would you make in terms of the regulations?
Well, certainly in the case of Credit Suisse, which you've alluded to, that was reported in the press, has also been reported in the press. Credit Suisse had an independent review conducted of that, and they proposed certain changes to the rules of the fund, but they continued to provide the fund. In the case of my business, I think as we got bigger, what we aim to do and what we would have needed to continue doing is to have further controls to separate the ability of shareholders to influence the extension of credit. But I'm satisfied that we did a fair job of that throughout this process, especially given that there was the disclosure to our end investors.
But what I'm hearing you say is that you do acknowledge that your shareholders did influence the extension of credit.
No, what I said is that there is a conflict of interest there, and that is why we separated our shareholders from the decision-making process around the extension of credit.
I'll let those listening decide what they think should be done, and no doubt we will comment on this in our report. Thank you, Chair.
Thank you, Harriet. Emma, please.
Thank you, Chair. I was a little surprised at the beginning, Mr. Greensill, to hear you discredit the evidence given by Lord Myners, and I do hope he is given the right of reply to this session to actually clarify some of the points you made. But I want to start with some pretty quick questions, if that's okay. Has Greensill ever been under investigation by the FCA?
I appreciate that it would be a criminal offence to comment on that.
Can you clarify whether you've been under investigation by the FCA?
The answer to that is the same.
Okay, so back in 2018, which is obviously prior to in what's happening now, when the FCA were looking into the GAM scandal, were they looking into Greensill as well?
I'm afraid the answer is the same. I can't comment on that.
So you can't comment on an FCA investigation that happened in 2018, which is not what we're talking about right now.
I'm happy to give advice on whether I am allowed to do that, and if I am, I'm happy to give you a written response on that.
Okay, thank you. And also, can you just confirm, obviously without naming recipients, whether you had 8 lots of £50 million loans?
Sorry, 8 lots of £50 million loans, I'm sorry?
Yeah, in answer, you didn't quite answer the questions to my colleague Washanara before about whether or not, you said because again you weren't able to give evidence, whether or not how many loans you actually had, C-bills loans.
Right. No, I'm not able to comment specifically on the facilities that we've extended.
Right, so I'm not asking for the names of the recipients, I'm just asking you to clarify how many loans you've had.
And I would need to take advice on whether I'm able to answer that question. And I'm happy to give you a written answer afterwards, if I am allowed to.
Right, let's try another one then. Did the government, officials, advisors or ministers play any role in introducing you to Mr. Gupta?
No.
Okay, can you explain how and when Mr. Gupta started working with Greensill Capital?
Yes, I did answer that question a little earlier, Ms. Hardy, but just to answer you again, I was introduced to Mr. Gupta in I believe it was in 2015 by an executive at an insurance company.
Okay, and following all the evidence you've given so far, I'm just going to ask you this as a straight question. Do you think it's appropriate that a firm like yours was not regulated by either the Bank of England or the Financial Conduct Authority?
Well, we didn't take deposits from consumers in the United Kingdom, and we the only product that we provided in the United Kingdom was business lending, and business lending, of which supply chain financing forms a small subset. Business lending is generally not regulated. So that's obviously a decision for this committee and for the government as to what should be regulated or not. I have said to you, you asked me to give you my honest assessment of why I think that my firm failed. And I think that the reason that my firm failed is because of our over-reliance on a single insurer who withdrew capacity, I believe, because of COVID-related events. And so that's my view as to why we failed. But I would say to you that we did own a bank, and therefore we dealt with a prudential regulator in the context of that as well. We do think that as we got bigger, we expected to be ever more regulated, and we welcomed that position. But our core business is not a regulated activity in Britain, nor is it in very many countries around the world, nor is business credit generally.
Okay, and now bearing in mind you obviously discredited the evidence of Lord Myners earlier, but Lord Myners said in the evidence he gave to us, and I'm quoting, that Mr. Greensill had clearly decided that he did not want his business to be regulated by anyone. Is that what attracted you to the business model you adopted, the lack of regulation?
Not at all. The business that we undertook is no better or worse for want of regulation. And you'll appreciate that much of our activities took place where we worked with counterparties that were highly regulated, and therefore we were required to operate to their standards. And so therefore, I don't see that there was any particular advantage granted to our firm by virtue of our regulatory position. So, for example, much of the business that we undertook of extending supply chain finance, certainly in Europe, was conducted through our German bank, and so therefore fully regulated.
Okay, now I understand you can't tell or answer the question as to whether or not you've been investigated by the FCA either now or back in 2018. But I wonder, Mr. Greensill, would you expect a business who was under investigation by the FCA to declare that to the Treasury and to the British Business Bank before doing business with them?
I don't have a view on that. We would be complying. We would comply at all times with whatever the legal requirements were.
Okay. In its written evidence to the committee, the Bank of England notes that the first indication that the bank had a potential weakness at Greensill was in March 2020. This suggested a possible weakness in controls rather than crystallized financial difficulties. That's a quote from the bank. Were you ever made aware of weaknesses in your controls? And if so, what was the weaknesses and what was your corrective action?
Yes, obviously I read the same letter that you did, Ms. Hardy. The Bank of England has not provided me with the particulars of what it was that they were referring to, so I can only speculate as to what I think they were referring to. But it is my sense that they are probably referring to discussions that were taking place with the Deposit Protection Authority in Germany around the concentration of one of our particular customers, and the plan that we'd agreed with them to progressively bring that into a lower level of concentration. But to be honest with you, I don't know, because the Bank of England didn't disclose to me what the nature of that correspondence was.
And did you not sort of think to ask, considering the Bank of England's writing about your company?
Well, I was only provided with these letters kind of a day or two ago. So no, I didn't think that I would get an answer from the Governor of the Bank of England in a matter of a day or two.
With you giving evidence to a committee in public, I just thought you might want to clarify what the Bank of England's writing about your company. But okay, how much contact did you have with regulators?
Well, the FCA Chief Executive's letter lists the interactions that we had with them. We aim to be proactive in talking to them about what we did and what we were looking to develop. For example, before we launched the earned product, we went and talked to the FCA about that product as well. We obviously had extensive discussions with the regulators in Germany over a long period because of our ownership of Greensill Bank. So I guess we had a dialogue with them. I don't think that our level of dialogue with the British regulator was anything like what a bank in Britain would have with the regulator. But I guess that's because we didn't take deposits here in the UK and we didn't extend credit that we were charging interest on to consumers.
Okay, and did the regulators take more interest in your business following the events surrounding the GAM fund in 2019?
I'm sorry, could you ask that question again, please, Ms. Hardy?
Of course. Did the regulators seem to take more interest in your business following the events surrounding the GAM fund in 2019?
Not that I noticed.
Okay, so there was no additional interest after GMA, is that what you're saying, in your business?
Not that I noticed, no.
Okay, why did you use the appointed representative feature for Greensill Capital Securities Limited rather than seeking to get the regulatory permission yourself?
Sure. You'll appreciate that Greensill Capital was a 9-year-old firm. We grew over a period of time. We worked with quite a number of broker dealers, so third parties who are very significant financial institutions who are major broker dealers on an international basis, so here in London and abroad. But over time, we determined that it would be sensible for us to have our own regulatory capability, but we expected that to be a pretty modest portion of our overall activities, and we therefore considered, given our size, that it made sense for us to make use of the appointed representative structure, which, as the letter from the chief executive of the FCA points out, is used by 40,000 businesses in the UK. I'm sure your question to me, though, really is there a lesson to be learned from that? I think there are two comments I would make to that, Ms. Hardy. One is that we fully planned and expected to move towards being doing away with the appointed representative and bringing that completely in-house. And indeed, we had discussions at a board level around that over the 6 months at the back end of last year. And But I think if you were looking to make changes and you were asking me that question, I would say there may well be a volume threshold limit where the appointed representative scheme should not be used. And obviously, although we started out being incredibly small in the appointed representative program, that grew over time as our business grew. And it may well be that there ought to be a threshold at which that's no longer acceptable.
Okay, now earlier on you discredited the evidence again from Myners, which was around the cost to the taxpayer being of 5 billion. You said it wouldn't be 1 billion either. I think you used the phrase, if I can remember correctly, around 400, a mere 400 million cost to the taxpayer. But you'll be aware that earlier on the FE released a piece which was titled "How Lex Greensill Helped Sow the Seeds of the Carillion Crisis." Now, you say that you weren't involved in the Carillion crisis in providing supply chain finance. You had a company, and I end up pronouncing this wrong, so you can obviously correct me, called Textura, which since was sold to Oracle, used Greensill as a supply chain finance, and they sold it, the debt, to Carillion. Isn't it the case that you have not only a hand in the Greensill disaster, which is going to cost the taxpayer billions, but also the Carillion disaster, which ended up costing around £7 billion of debt?
I'm sorry, Ms. Hardy. Did you say that?
I'm asking
would you mind reading me the quote, because that doesn't make any sense to me.
The involvement in the Carillion crisis in providing supply chain finance. A company called Textura, which was since sold to Oracle, used Greensill as a supply chain finance and then sold it to Carillion. So I'm asking what the link is between Carillion and the debt that ended up costing the taxpayer and your company, Greensill.
Textura was purchased by Oracle.
Yes. Used Greensill,
not by Carillion.
Used Greensill as a supply chain finance and then sold it to Carillion.
No,
Okay.
that is not correct.
So sorry. So Textura, which was sold to Oracle, did not use Greensill as a supply chain finance. That didn't happen.
No, Oracle through Textura did use Greensill for providing supply chain finance. What did not happen is Textura was not sold to Carillion, and Textura did not sell a supply chain finance program or capability to Carillion.
Right. So the journalist has got that wrong.
It would seem that the journalist has.
Okay, that's fine. So you had no hand in the Carillion crisis whatsoever through using Greensill supply chain finance?
Absolutely not.
Oh, well, that's one thing you can cross off your list then. That's good. Okay, thanks very much. And there are press reports that you struggle to find a new auditor to replace Safri Champness. Is this true?
So our group auditor was Nexia International, of which Safri Champness is the UK member. Nexia International, according to their website, is the 8th largest audit firm in the world. We did business with Nexia at the request of our auditors. I apologise, our regulator in Germany, who specified that they wished us to continue to use the same auditor at our bank as had been in place before we purchased the bank. And that meant that we actually needed to switch, because prior to that, our auditors were Grant Thornton. And then when we purchased our bank in 2014, one of the conditions of that from one of the regulators in Germany was that they required us to continue to use the bank's auditor, and Grant Thornton would not have that be the case. And so therefore we had to use the international group, of which the German auditor, which is called Ebner Stolz, formed a member of, which was a part of the Nexia group. But to emphasise, Greensill Capital is an Australian company, and so the principal auditor is Nexia International, of which Safri Champness was their UK partner, and they audited our UK operating entity.
Thank you. How easy do you think it was to audit Greensill? And where did auditors have to pay particular attention, and what did they often ask you about?
I'm not an auditor, so I don't know whether auditing our firm was kind of any easier or more difficult than auditing any other financial institution. I would say to you that kind of the volume of transactions that we financed is a significant number, because they are, in effect, lots of relatively small receivables that we purchase, but they're centralised into a couple of country jurisdictions. But of course, we did business in many countries around the world, and no doubt that creates a level of complexity.
Okay, final question. What was the news that Greensill representatives said that they were, quote, very pleased to hear from the Treasury in an exchange of emails on the 24th of April 2020?
I don't immediately know what it was that particular news, so I'm afraid I don't know the answer to that question off the top of my head, but I'd be happy to consult my notes and see what that was and provide you with a written answer, Ms. Hardy.
Okay, so just to clarify, you're going to be writing to us if you can to let us know whether Greensill has been under investigation by the FCA, and to clarify what it was that excited Greensill representatives so much from the Treasury on the 24th of April.
Correct.
Thank you. Thank you, Chair.
Thank you, Emma. And going to go to Anthony, please.
Thank you, Chair. And I refer everyone to my members of registered interest. I've been an investor in and on the board of and an advisor to a large range of financial technology companies, one of which Hasty is in the same line of business as Earned. And I used to work at Morgan Stanley as well, but I don't think we ever overlapped or met there. My first question, I just want to follow up the point that Emma Hardy was asking about. That were you saying it's against the law for you to say whether you have been investigated by the FCA in the past? And if so, which law is that?
I would say, Mr. Brown, that I don't want to break the law, and so what I've said is that I will provide you with a written answer if I am allowed to do that. I have not brought a solicitor with me to this hearing.
I thought you were a lawyer yourself.
I'm not an expert on UK regulatory matters, Mr. Brown.
Well, as former Chief Executive of the Bank Association, I can tell you people are quite open about whether they've been investigated by the FCA in the past. So I might be wrong, but I certainly don't think there's any law about that.
In which case, I will provide you with a written answer to your question.
The two things I'm interested in finding out in my questions to you are really the regulatory lessons from this, and you've touched on a bit of that, but then also about the potential use or abuse of public authority. On the regulatory lessons, as you said, supply chain finance isn't regulated. It's business to business lending. It's it's a civil contract between two businesses. You did suggest there are aspects of your operation where regulation should change, like the appointed representative regime. You've said there should be a volume threshold, and that sort of makes sense. When you get a certain size, you can't use that anymore. Are there any other aspects of the operation that you think regulators should look at? We are speaking to the FCA tomorrow.
I think that it is the case, as indeed Lord Myners said, that it is important to think about the asset liability mix of kind of all financial institutions, and particularly ones such as mine. And so I think he was right to ask those questions. And I would suggest that there definitely is a question around financial technology companies making sure and having robust controls around their asset liability matching. In our case, the reality was the assets and the liabilities matched, but only with respect to part of our business, only so long as insurance was there. So kind of regular asset liability rules would say you were fine, but in fact, actually not necessarily take account of that critical ingredient of the insurance. So it seems to me there may well be some merit in giving that further consideration, Mr. Brown.
And what would be that merit? Because normally the attitude of the regulators is, as you said, it's consumer protection and deposit protection, and you
Yes.
didn't take deposits, and your consumers, as I understand, didn't lose out directly. But what would be because if we're going to make recommendations about changes to regulation, it'd be good to understand exactly what the benefit would be of doing that, and how widely you would do it.
Yep, Mr. Brown, I'm not a an expert here, I guess I wanted to just call your attention to that clearly is a consideration, the way that insurance fits into asset liability management. I'm not sure what the appropriate formulation would be. I would say with respect to insurance, the principal question that I would kind of ask you to perhaps consider is that inherent kind of counter cyclicality of insurance, and I'm sure you have seen this in your previous capacities writ large, where credit insurers withdraw credit insurance at exactly the moment when it is most needed in the economy because of the way the solvency regulations work. And that seems to me to be an inherent flaw, and the failure of my business is in part evidence of that flaw, it seems to me.
Okay, I don't want to ask about your public sector work. Obviously you had in a lot of dealings with government and clients of government. How important was that to your business model, the public sector versus your private sector work?
Certainly. From a revenue perspective, the public sector business was negligible. From a volume perspective, it was moderately important. It accounted for a couple of percent of our volume on an annual basis, I would approximate. But I think to us the value of the activity that we undertook in government was, if I can be maybe tell you a truth that is uncomfortable for people in government to hear, the truth is that government tends to be less efficient than the private sector. And so when one is working to make savings, it's easier to prove larger savings in a public sector environment. And when you are a business that doesn't have a brand that everybody knows, and therefore people are looking at actual value cases where real value has been captured, that's certainly something that's very kind of evident in the business that we did for the government. And as I cited to you, there are very, very significant ongoing savings in the procurement of drugs in this country as a consequence of that solution. So it is that as a proof case which the private sector then looks to when they're considering what they're doing in terms of improving their own supply chains.
I completely agree with you about the inefficiency of government and the ability in certain circumstances of private sectors to help increase in efficiency. Just on the supply chain finance with the pharmacies, which you just mentioned, that presumably if the government did pay its bills on time within, say, 10 working days, then there would be no room for any supply chain finance.
I'm very glad that you raised that point. It is, of course, government policy to pay suppliers within 10 days.
That's the point. Yeah, and I was in charge of the payment terms in the Greater London Authority and Boris was mayor.
Yes, and so on the face of it, it's crazy to implement supply chain finance. It's crazy to use private sector money, which on the face of it ought to be more expensive than where the government can borrow money to do this. And it's crazy to have an intermediary in the mix who's presumably taking some profit out and therefore is effectively a tax. The truth, unfortunately, Mr. Brown, is somewhat different. The truth is that unlike the private sector, government doesn't have the capacity to approve its invoices very, very promptly. And so as a consequence of that, there is a delay. Even though you want to pay within 10 days, there is often a delay. That delay, if one looks at what the private sector does, that delay can be solved using analytics, machine learning, algorithms to accelerate that process. So one, private sector can bring that learning, which is part of what we did. The second is paying suppliers faster. So previously government paid in 30 days and then it was changed to 10 days, arguably, why not pay them in 1 day? Well, that's actually a cost to the taxpayer because the Exchequer has to borrow that money to provide it. What the private sector does with the supply chain solutions that are provided is that allows the people who benefit from it that is the suppliers to government, if they want to get paid faster, they can pay for it rather than the taxpayer paying for it, because the truth is the majority of expenditure the government has with suppliers is not with small businesses, but is with massive multinationals. And do you really want to be subsidising their cost of capital? So have the private sector provide it, and have those that want to use it take advantage of it. And the third point then, and the final point that I would make, is that in fact, even if you did devolve to government departments the authority to pay using private sector technology and just use their own cash, the reality is that that capital is charged out at a much higher cost by departments than the private sector provides. And the reason for that, as I'm sure you're very aware, is that although Treasury can borrow money very cheaply, it provides it to departments at, and I'm not going to use the right word, I'm sorry, but effectively a weighted average cost of capital, that where overall the government borrows money. Whereas if you're advancing money to a supplier to government on 30 days faster than they were getting paid before, then I, as a financial institution, am borrowing money for 30 days, taking government risk. That's a lot cheaper to fund than 10-year weighted average cost of borrowing for the exchequer, which it passes through to departments. And I'll use the 10-year as an example. But so there's a very big difference between the two. And so have the private sector benefit from it, have them pay for it, but have it actually be cheaper than the government departments would actually be able to do that based on the cost of capital that Treasury provides. That was the rationale for doing what we did.
Can you explain exactly what your role at Number 10 was when you were at Number 10?
So I was brought into the Cabinet Office in 2012, and as you'll appreciate, it was in the wreckage post the financial crisis, where there was a real focus on helping small businesses and help improve their access to credit. So the challenge that was leveled to me was, are there ways that I could provide advice based on my experiences that would enable government to make interventions that helped small businesses to get cheaper access to credit or better access to credit. So that was the reason that I was brought in, and I provided those services to the government at no cost. I was simply trying to share my experience and give something back.
And this is before you set up Greensill?
No, I had set up Greensill as an Australian company, and so Greensill was set up in late 2011. And I was engaged by the Cabinet Office in February 2012.
And so did you use your position in the Cabinet Office, as you say, to influence any commercial contracts with government to gain access to people who might be interested in signing contracts with Greensill?
Absolutely not. The first government-related business that Greensill Capital ever won and funded against was in July 2018. And Greensill Capital didn't have any customers here in the United Kingdom until 2015. So
after you left the Cabinet Office?
Actually, I was still a Crown representative at that time.
And what's the role that, I think that this Crown representative, I must admit, I'm not really aware of their role. What do they do?
I didn't create the scheme, so I'll give you my potted version of it, Mr. Brown. But I think the intent behind the program was to bring private sector expertise and to assist with commercial negotiations with suppliers to government to ensure that government could get the best possible deal.
And so you were a Crown representative while trying to get contracts for Greensill with the government?
No, sir. What I said is that the first time that Greensill Capital had even a customer in Britain, nothing to do with the British government, but a customer in Britain, the first time it did was in 2015.
And you were no longer a Crown representative at that point?
I was a Crown representative at that point. that company had nothing to do with the government.
And by the time you had a first government contract, you were no longer a Crown representative.
It was more than 2 years after I had ceased to be a Crown representative, sir.
Right, because there was there was an article in the Times on the 27th of March 2021, noting confusion about how a report ended up on the then Prime Minister David Cameron's desk advocating supply chain finance for pharmacies. And it was confusion over how that report actually ended up in the Prime Minister's red box. I'm sure you saw it. Did you have any involvement with the writing of that report?
Unfortunately, the Times didn't provide me with a copy of the report that they're referring to, and given that I'm ceased having access to government email systems more than 5 years ago, I'm not able to see the exact report or the correspondence that related to that. But what I can say to you is that it would not have been possible that a report that I could have written would have ended up in the Prime Minister's box. I'm sure, Mr. Brown, you're aware of the processes and controls that sit around that. It would simply be impossible for an advisor to write a report that ended up in the Prime Minister's box unless it had been reviewed by others and determined that it was worthy.
By Jeremy Hayward, another former who you met at Morgan Stanley.
That's correct.
But
it's correct. I met him at Morgan Stanley, Mr. Brown.
Yeah, but he could have put the document in the Prime Minister's box and could have got it from you.
I can't speculate as to that, Mr. Brown, but I guess that's possible. He was the Cabinet Secretary.
But you don't know whether this Times report is true, though, about whether the report you wrote ended up in the red box about supply chain finance for pharmacies, which then the Prime Minister then adopted as a policy.
I wrote a number of papers that it's my belief ended up in the Prime Minister's red box, and the pharmacy scheme was a scheme that was announced by the Prime Minister at the roundtable that was held. I think it was in October 2012, I think, if my memory serves me correctly. So that formed part of the group of announcements that were made by Number 10 in conjunction with that roundtable.
Okay, I would love to ask you more questions, but I'm afraid I've run out of time, but thank you very much.
Thank you, Mr. Brown.
Thanks, Anthony. And going back to Angela, please.
Thank you very much. Why did you have David Cameron as an advisor to your company, Mr. Greensill? What was his role?
Certainly. So my board and I decided to approach David Cameron to prospectively become an advisor to us. Actually, in the event of we had recently lost a procurement process with a significant blue chip company, where, although we had the better technology, that company had taken the view that they didn't recognise our brand, they didn't know who I was, and so I guess we were thinking about how we could grow and expand the brand awareness of ourselves as a firm.
Okay, and prior to him joining the company, how much contact had you had with him, particularly in your time in government?
I met him a couple of times in the time that I worked for the Cabinet Office.
But you would say then you didn't really come across him very much.
But
you didn't really know him.
I wouldn't say that Mr. Cameron and I were friends. No.
Okay, what is his job description and role, would you say? I mean, we've seen advisor, but can you enlighten us a bit more about the job that he's been doing for you?
So Mr. Cameron advised us with respect to the growth of our business. In the time period that Mr. Cameron was an advisor to our firm, we added more than 100 countries to the number of countries that we purchased receivables from customers in, and of course that analysis and geopolitical thinking was something that Mr. Cameron assisted us with. Mr. Cameron also met with many of our current and prospective customers and indeed partners that that we did business with, and generally assisted us with the growth of our firm.
Okay, so clearly a successful relationship from your point of view. How was he employed? Was he a PAYE employee, or did you pay him per hour, or what?
He was a PAYE employee.
He was a PAYE employee. Okay.
Yes.
And was he employed by the UK part of the company or by a foreign part of the company?
The UK.
Okay. And was he, even though he wasn't a board member, I'm assuming he wasn't a board member?
That's correct. He was not a director of the company.
Okay. Did he attend board meetings?
He had a standing invitation to attend.
And did he do that regularly?
Yes.
Okay. What were the value of the share options? Well, certainly the percentage of share options that he was allocated. We've heard 1% bandied about. Is it that, or is it different?
You'll appreciate, Dame Angela, that I'm not allowed to kind of give you the exact numbers, but I can tell you that it was less than 1%.
Less than 1%? More
That's
than
correct.
0.5%?
I'm not going to haggle with you, but I would say it's less than the 1% that's been bandied around in the press.
Okay. Is there any reason why you can't tell us what that is? There doesn't seem to be any reason. I mean, lots of people think money's quite a nice thing. Are you embarrassed about talking about money? No, I'm very careful though about respecting the confidence of people who are employees of the company, and I understand that Mr. Cameron's giving evidence to you in 2 days' time, Dame Angela. So perhaps it would be most optimal for you to ask that question directly of him. Well, I had noticed that we've got that coming up, so don't worry. I'm sure that some question along those lines will come from one of us, maybe not me. Who knows? Before he agreed to approach the Chancellor about the CCF scheme. Did you give him any briefing notes to let him know what it was you wanted him to lobby for on your behalf? So Mr. Cameron and I definitely talked about the matter before he spoke with anybody in Bank of England or in Treasury. I believe that he had sight of the submission that we had made to the Bank of England when they would, prior to the implementation of the CCFF, I'm sure you've perused the material that the Governor of the Bank of England provided. We heard what the then Governor had said, where he had said that he thought that there would be need for a Bank of England support for supply chains. And so we wrote to him. So Mr. Cameron had seen that. And then once the scheme was announced, Dame Angela, we made an application to the Bank of England, and Mr. Cameron would have had visibility to that application. I don't recall that he would have been provided with anything above and beyond that which we had provided, and therefore is now in the public domain. Okay, so there's nothing else to publish about that, as far as you can tell? Not to my recollection, Dame Angela. And how much use did Mr. Cameron make of your private jets, the 4 that your company had? That would be for Mr. Cameron to comment on, Dame Angela. Oh, come on, that's not a secret, surely. I mean, it's a cost for your company. Again, we've seen these photographs of him all over the place talking to people. He must have made some use of your private jets. Did he have one to hand, or did he generally go with you? What was the way that you organised the use of these private jets in the company? Sure. The private aircraft that the company had were for the use of executives of the company, and David and I, apologise, Mr. Cameron and I did travel together on company aircraft, and that was certainly an efficient way of getting around. So presumably there's records of all of that? Absolutely. There are records of every aircraft usage that ever took place. Okay. And why was Mr. Cameron meeting with your insurers in Australia? Because there was a meeting there that you had with insurers. That's correct, he did. So Mr. Cameron was in Australia speaking at
an event out there. Forgive me, I realise you're going to want to know who that is. So he was in Australia on a speaking tour where he was speaking for the at the invitation of the United Israel Appeal. And given that he was in Australia already, he provided one morning of his time while he was there, and during that time he met with a group of our current and prospective customers, and also met with the one of only 2 Australian insurance companies that we worked with. He met with the chief executive and a number of other board directors of that insurance company, together with our broker Marsh, and that was consistent with what he had done in meeting with other insurance companies who partnered with us, and other institutions generally that worked with us.
Okay, that's good, thank you. And finally, did this is just something that's come up from something you've said in earlier evidence, but did Credit Suisse ever reject any paper that you offered for securitization?
Yes, they did.
And was that a regular occurrence?
I would think it probably happened a couple of times a month, I would think, Dame Angela. And you may say, well, why was that not more frequent? And the answer to that is that the funds that Credit Suisse operated had very clear rules around the eligibility of assets that could go into them.
Yeah.
We didn't change customers very often, because you'll appreciate once you're financing the supply chain of a company that you kind of keep doing it for an extended period of time. And so consequently, it would be unusual for them to reject a transaction. Most likely it might be if it's, for example, a new customer that perhaps they didn't adjudicate was within the rules. But in terms of actual limits, those limits are just a mathematical calculation relative to information they've told us as to capacity and the rules of the fund. So obviously we wouldn't offer them something that we knew to be in breach of the rules. Does that answer your question?
Okay, so they turned you down sometimes. What did you then do with those assets that you tried to securitize?
Certainly, Credit Suisse was definitely the largest of our investors, Dame Angela, but it certainly was not the only one. There were 52 banks that bought assets from us, and several dozen institutional investors who also bought assets from us, including many significant institutional investors here in Britain that you would know well. And so, an asset that was offered to them, if they declined it, would likely end up being purchased either by Greensill Bank or by one of the dozens and dozens of other investors who purchased assets from us on a daily basis.
So your own bank purchased the assets if you couldn't send them perhaps to the Credit Suisse funds. This is the bank that the BaFin are now investigating, isn't it, in Germany?
That is correct.
Yeah, and they're looking at criminal charges over there, are they not?
There have been no criminal charges laid against staff of Greensill Bank, but I've certainly read of the commentary in the press.
And there are some German towns who invested institutionally in that bank that have lost a lot of money as a result of what's happened.
Like you, I have read that in the press as well.
Yeah. So there's more than one loser here. Thank you very much, Chair.
Thanks, Angela. And finally going to Julie, please.
Thank you, Chair, and thank you, Mr. Greensill. Just although we're at the last hurdle, I'd just like to recap the first questions that the Chair asked you about Lord Myners and your meeting. And just to be very clear, Lord Myners told this committee, I was contacted by somebody who said that Lex Greensill would like to meet with me, so I went to meet with Lex Greensill. Am I correct in recalling your answer saying almost the opposite, that someone told you that Lord Myners wanted to meet with you so that you met with Lord Myners?
Correct.
Okay. What why did you want to meet Lord Myners? What were your motives in taking that meeting? You're running a huge company, you've got other commitments, I'm sure. Why would you want to meet someone who has been quite hostile, asking very difficult questions about your company?
Sure. First of all, Lord Myners is a very respected member of the financial establishment, an ex-regulator. We were a growing firm. He had, as you'd said, raised questions about our firm and others in Parliament. And so I was very keen and very happy to meet with him because it gave us an opportunity to, one, kind of learn from his views. And he has some very clear views around the way that open-ended funds and illiquid assets should interact with one another, which he's been outspoken on. I was very keen to ensure that he understood the nature of our business and the assets that we purchased in our business. And so we had a constructive conversation around what his concerns were, the way that our business worked. And he noted that, you know, there are risks within our business, but those risks were different to perhaps what he had initially anticipated or viewed that those risks were. And I certainly recognise that there is and always is room for continued improvement in terms of compliance. And as we were growing as a business, it was inevitable that we were moving into more regulated spaces, and therefore his input was invaluable.
He called you a very charming man. Did you use your charm to kind of buy him off, really, get off your back?
I told him the way our business was, and so if he regards that as charming, I'm gratified that was his view.
But was the offer of a job, or the talking, you know, the progressing of an offer of a job, was that a genuine gap in your board capability, or was that just an ad hoc? Well, this just occurred to me right now. This seems like a good idea.
Look, if you were to look at the composition of our board, you would see that we don't have anybody with a regulatory background on our board. Our business was growing, it was heading in the direction of potentially becoming a public company. And so therefore that expertise is expertise that we saw as valuable. When Lord Myners ultimately declined, we ended up hiring a very significant regulatory expert as vice chairman of our firm in his, you know, because Lord Myners didn't take that position. So I guess from that perspective, we were hiring, and we did hire a very significant person with real credentials in that space.
And did you relay the results of that meeting and give David Cameron a mission to talk to Lord Myners? We know that he ran into him at a meeting some weeks following that and made sure that he spoke to him. Did you give David Cameron a mission on that, in that respect?
No, I don't recall giving David Cameron a mission. I'm not sure I ever gave David Cameron a mission, but I believe that Mr. Cameron met with Lord Myners in October 2019, and my meetings, as I mentioned to you earlier, were in July and September of 2019.
Thank you. One of the people who did lobby the Treasury on behalf of Greensill was Bill Crothers. How did you come to employ Bill Crothers?
So I met Mr. Crothers in connection with the fact that he was, if my memory serves me correctly, he was the senior civil servant responsible for the Crown representative program, of which I became one. And when Mr. Crothers ceased to be the chief procurement officer, chief commercial officer, I apologise, in the Cabinet Office, he and a new person had been appointed to that role. He was thinking of other things to do, and I invited him to be an advisor on a part-time basis within our firm, and he started as an advisor to us after he'd ceased to be the chief commercial officer.
he was still the government chief procurement officer for at least 2 months, wasn't he? When there was an overlap in that time in the Treasury, which was being referred to by civil servants as extraordinary, that that double hat position was allowed to happen. I mean, did you think that was a conflict of interest, or did you just think you were very lucky?
Ms. Marsden, just to be clear, he was no longer the chief commercial officer or chief procurement officer at the point that he became a part-time advisor to Greensill.
There was no overlap. So the discussion.
He continued to be. He was still an employee of the civil service, but he was no longer the chief commercial officer. Is my recollection of events.
What was his role in the civil service at the time you employed him then, just to be clear?
I don't actually know what his title and role was, but I think he was in a process of kind of helping his replacement with their transition. But to be open with you, Ms. Marsden, I'm speculating when I say that. I can find out exactly for you and provide you with a written answer if that would be helpful to you in the committee.
That would be very helpful, because there has been a lot of comment about the those dual responsibilities, that potential conflict of interest, the double hatting. I mean, it has been described, I think it was in a previous committee, it was described by current civil servants as quite extraordinary that was allowed to happen. So that's been talked about as if that was actually happening. I mean, it might have preempted the next question, which was really, did you ask Jeremy Haywood or John Manzoni, who was obviously the head of the civil service there, the chief executive, to approve that position, that overlap, that double hatting situation?
Absolutely not.
Okay, thank you. Mr. Crothers' consultancy was called Commercial Common Sense. Is that the vehicle that you paid him via? Was that the entity that you paid him to?
I don't know the answer to that question off the top of my head. That wasn't a detail I came armed with today. My recollection was that he started out when he was part-time through a consultancy entity, but he became an employee. And at the time that he was full-time, he was an employee of our company. And at the time of our company going into administration, he was still an employee of the company.
And what did he do for Greensill for you over this period?
Sure. I think one important detail to share with you is that, again, the time that he left the civil service, so ceased to be a civil service employee, was in November 2015. And the first UK government contract that we funded on was in, I believe, July 2018. But Bill Crothers' role was to assist us with bringing order to our sales function on a global basis, and he had a role with us once he became a full-time employee of actually heading up our what we call origination, which is kind of fancy speak for sales. So basically oversaw the client interactions that our firm had with clients around the world.
But that doesn't really kind of cover the fact that he was lobbying for Greensill as well. What kind of lobbying activities did he do? What did you want him to do that related to his role as well, and his previous role within the civil service?
Mr. Crothers wasn't lobbying government. We didn't actually have any government business for the 2.5 years after he joined our company. So his focus was on private sector. Now, after we won the first contract that we had with the UK government, which I should emphasise was won, contrary to what was said in this committee 2 weeks ago, was won through a very intensive competitive process. Indeed, the actual letting of that contract was actually conducted as a straight out auction on price, where our pricing was 40% lower than the incumbent, and was the basis on which we were ultimately selected. But after that program was in place, Mr. Crothers then worked within a leadership role within our earned business, which was the product that was providing daily pay to employees, both within the NHS, but actually also we were aiming to develop that for the private sector as well.
Okay, thank you very much. I think I'm out of time. Thank you, Chair.
Thanks very much, Julie. I'd just like to quickly follow up on the lobbying questions here, Lex, and go back to my earlier question right at the start. So I think you said that the first time that you realised that Greensill was really in trouble was at the end of 2020. I think you may have said December, which is also exactly the time that David Cameron says he first became aware that Greensill was in trouble. In his letter, his recent letter to me, he says the first time I became concerned that the company might be in serious financial difficulty was in December 2020, following a call I received from Lex Greensill. Now that, of course, is quite distant from the period during which the actual lobbying was being carried out, and hence my earlier questions about what the motivation for the lobbying and trying to tap into CCFF was at that point. I think you went as far as to suggest that with the pandemic, which of course ended up causing lots of problems for Greensill, it was helpful, or would have been helpful if CCFF access had been achieved in terms of providing additional security for the business, given the uncertainties ahead. Was that a discussion you had with David Cameron at that time? So did you share those fears with him about the uncertainty going forward and the impact it might have on the business, and therefore the fact that access to CCFF might have been useful in that specific respect?
Mr. Cameron and I talked about the fact that there was uncertainty in capital market liquidity, and that could absolutely affect our clients. As ultimately, and the numbers prove this, the volume of receivables that we purchased in 2019 was 143 billion US dollars, and the amount that we bought in 2020, incidentally enough, is actually also just a whisker over 143 billion dollars. So, in fact, the events of COVID meant that we were able to provide the same quantum of liquidity to our customers over the course of 2020 as we did in 2019, in spite of the ructions in the market. But we didn't know in March and April exactly what the future would hold.
I'm not sure that entirely answers my question. Let me rephrase it. So what I'm saying is, perhaps put it this way, would it be fair to say that your motivation personally in lobbying the Treasury over CCFF was, yes, certainly about providing support for SMEs, but it was also about providing that additional safeguard given the uncertainties that there could well have been around the business at that time. And that would also have been the motivation of Mr. Cameron at that point, that he would have been concerned to have got that support on the basis that the business needed a little more certainty, a little more shoring up than was the case at that particular time with the pandemic taking off.
Mr. Chairman, we had just received more than $1.5 billion of equity investment from Softbank Vision Fund only a few months before that. There was absolutely no risk to Greensill, the company. Our concern was making sure that there were alternative sources of capital available if capital markets continued to be in a distressed state.
Yeah, so it was a kind of hedge against what might happen if things kind of went the wrong way, yeah.
And that was the reason that the Bank of England put the CCFF in place, was and why many corporates signed up for it, but then ultimately did not use it because they regarded that as a safety mechanism, I guess, for want of a better word, Mr. Chairman.
Okay. Thank you. That brings us to the end of this session. You're probably quite relieved about that, Mr. Greensill, but thank you very much indeed for appearing before us. We've covered a lot of ground today. You very generously and kindly said that you will write to us on various matters. I think probably a good way to proceed here will be for us to write to you in very short order, setting out the things that we believe you've agreed to write to us upon, and also perhaps to ask some other questions that may occur to us after this session. It's been quite robust, and I think in some parts it's been a very robust session, but nonetheless we are a courteous committee, so we do appreciate you having put yourself before us today and for having answered the questions that you have. That concludes this session. Order, order.
Thank you, Chair.
Committee Room 18. Committee Room 18.